uh, you could stand in the pit and lift your feet off the ground. That's how packed it was, by just putting your elbows out.
So, did it fit the often seen videos that we see in movies of people screaming, holding slips of paper above their heads? Is that remotely accurate?
No, it's not. It is 10 times crazier than that.
Oh, really?
These traders are fighting for their life. It's not like a rock concert. Every trade that these guys do, their livelihood depends on it. It truly is something that, and they didn't allow cameras down there. Very, very crazy scene.
So, was it those with the loudest voices and the tallest who could reach the highest? Did they have an advantage?
Oftentimes, yes, in terms of getting orders filled, they would have an advantage. So where you stood in the crowd made a big difference, and being able to stand to closer to order flow. So yes.
You mentioned about charting and that you would look at charts. Now, this is in the days before the internet. What kind of technology did you use, and when did you start using it? What was the format of you looking at charts? Was it just all on the screen, simple line graphs, or?
Well, early on, I wasn't doing any charting. I was really focused on the execution side of the business. So not as much trading, but by 1999, 2000, everything was going online, and then trading software was very available. So I was using very similar charts to what you would see now. Realtic was the trading platform that I used.
And you mentioned that you worked with institutions getting option orders in. Is that correct?
Yes, way back when, you had to have an exchange membership on all the option exchanges to be able to execute an order on them. And so we would be the executing broker for other large institutions like Goldman Sachs, Morgan Stanley, Ameritrade, PBS. So we would offer that access to all the different exchanges with direct phone lines down to the floor, and our own presence and our own floor brokers and independents that we used.
Do you know back then, to what degree did these institutions that you work with actually look at and or use technical indicators when looking to acquire or dispose of positions?
Well, we didn't really know who was on the other side of the trade or what tools they were using to execute the trade. We only knew that they had an order to get the trade done at a particular price and a particular quantity. So it was our job to try and establish the price and to get the best price out of the trading crowd. But technology was definitely used by a lot of firms. Chicago Research and Trading, for instance, in the OEX pit, which was the most liquid options contract in the world, used TV screens, and you could be a floor broker for them. And if the upper left corner of the screen went to magenta, you knew that your job was to do X. And another person trading for them, if they saw the lower right-hand corner go to yellow, they knew they had to do something different. So nobody had a complete idea what the total puzzle piece was. They all knew their own individual pieces of it. So technology's been around for a very long time.
Back then, did they have dark pools or any other way that institutions could mask their entry into or out of stocks or options?
Well, back then it was much more a kind of a relationship and a network. So it wasn't done virtually, but it was done via phone calls. And so you would know who the other large institutional holders are of a particular stock if you're looking to buy or sell. And so as a broker, you would go and you would shop that order. You knew that you had 50,000 shares to buy, and you thought, well, I think I know some firms who have a position that might be interested in selling. And so the trade is arranged off floor and then crossed on an exchange. So the buyers and sellers meet. So in essence, it was kind of the same, because the buyers and sellers were communicating, not necessarily in the public eye, public display.
So how old were you when you actually set up your first trading account?
I was 27 years old. It took me a while to figure out that this is what I wanted to do, and there are many members of mine who are much younger than that, who are getting an early start on this. So it's pretty exciting for them.
Yeah. How about your coworkers when you were on Wall Street? Did any of them trade? And if so, did you share trading ideas and or have any mentors?
We did share some trading ideas, but most of them did not trade. It was very difficult because every trade that you would do, you had to have cleared through compliance before you did the trade. So I would drive my compliance officers crazy because I'd constantly be running in there with trades that I wanted to do. So
Uh-huh.
it's very difficult too within a
Oh,
brokerage firm.
wow. Did they come back and say, "Hey, why don't you just be a buy and hold investor so we don't have to spend so much time with this?"
Yes, they would. Yes, my compliance officers would go kind of nutty on me. So yeah, I tried to tone it down, but that's another reason why I had to leave the brokerage industry, because I didn't need that hurdle and that obstacle. I wanted to trade.
How old were you when you were able to trade freely without having to go through a compliance officer?
So in 2002, I was 42, and that's when I resigned from Terra Nova Trading and started to trade on my own. And it was a very difficult start. So I knew all the hardships I had seen. So, one thing about my background is that I have seen it all. I have tried it all. I know what works, what doesn't work. I know it from the institutional and the floor side to personally trading, to watching thousands of retail traders and to watching some of the really successful larger traders trade. So I knew what the obstacles would be. And eyes wide open, I knew that this is a career change for me. And when I started trading, it was one of the toughest market conditions I've seen. I had about $250,000 in capital, and 150,000 was my stop loss. And so I was preparing that it would not go smoothly, but it was very disheartening. The first 8 months, the market had this Chinese water torture, drip, drip, drip lower than just the tightest trading ranges. And we had come out of the tech bubble, and we were preparing to invade Iraq. And so nobody was really willing to stick their neck out and do any kind of big trades. And I was leaking oil. Plus, I had my expenses to cover. So a grueling period. And so I kept my wife apprised of what was going on. And my friends, my family, everybody wondered why I was doing this. And they were concerned. It was a very isolated feeling.
So you didn't have any fellow traders to commiserate with or to talk this over? Did you trade alone?
Completely alone. Yes. And very isolated. So I spent all of my time just doing research and analyzing. And the good news is that I was learning, and I was learning under the toughest market conditions. Hence the reason I congratulated people who have been around for 18 months, because last year was a tough year, very, very choppy, and difficult time to learn how to trade. And if you've been trading for a while, difficult as well, because most people have not seen a bear market. But in 2003, April of 2003, the market turned around. We invaded Iraq, mission accomplished. George Bush on the aircraft carrier after 2 weeks, and the market lifted off. And all of a sudden, the lessons that I had learned that I did not realize I had learned all of a sudden came to fruition. And it was kind of like shooting fish in a barrel. It's
Hmm.
very, very easy.
Interesting. So, what were some of the lessons you learned both during your time in Wall Street, having to deal with the compliance officer, and then after when you left during the bear market of 2002? What were some of the types of strategies or stocks or options you'd pick, and what did you learn during that process?
A lot of it was really identifying patterns, trading patterns that worked. And I also gained a real appreciation for the importance of the market. And so I started to develop a trading system. And when most people hear about trading system, they think about some kind of mechanical, regimented uh, type of system. It's a decision making process, and it has a flow to it. And the market is at the very top of that flow chart. And the market is about 65% of the total puzzle piece, and it still is for me. The market drives all of our decision making. So if I'm looking at what was happening and why I was leaking oil, it's because of the market. The market conditions were extremely tough. Even within the market conditions that I was faced with, there were still really decent trades that I had. So, what was distinguishing the good trades from the bad trades? And what I started to realize was that, hey, you know what? These stocks are holding up extremely well. In fact, some of them are ticking higher when the market is going down. They are strong relative to the market. And that became a major tell for me because it was a sign that institutions were in there buying. 75% of all stocks follow the market. Well, when they don't, there's a reason for it. And these institutions don't necessarily care that the market is going down today or tomorrow. They're looking a year out and they're accumulating shares. So when the market goes down and the stock stays flat or inches higher, you know that the smart money is in there buying. And so that became another part of my systematic trading approach. And I had realized that and I had recognized it. So that became one of the cornerstones to my approach.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including zero commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So you're noticing these stocks during the bear market of 2002 either not falling as much as a market, starting to firm up, and in some cases start to trend up even as the general market goes down. So were those stocks, did they outperform the market as well when the market turned around in early 2003?
Exactly. That's exactly what happened. So the edge that we employ is, and you have to have some type of edge. You need to understand what the edge is, and more importantly, you need to understand why is it that it works. And the reason that this edge works is that when the market is going down, and let's say that you feel, okay, it's bottoming, and now I feel the market's going to reverse and it's going to go higher. Well, let's say you get the market wrong and you're trading S&P 500 futures. If you were early and the market goes down, you are going to lose money, period. However, if you use a long stock position as a surrogate market position, and that stock has relative strength, the market could go down, but because the institutions are in there bidding for that stock and wanting to accumulate it, that stock will tread water, sometimes even go higher. So even though your timing might have been off on the market, you're not going to have your head handed to you. That's a huge edge. Now, if the market does go higher and you got the market right, that stock is going to take off. It'll be like throwing gasoline on the fire. And so the whole concept is really to follow the smart money.
And does the same apply for during, say, a bull market? If a particular stock or sector is starting to weaken and starting to go down and flatten, is it works the same in reverse?
Absolutely. You can see which stocks are already starting to leak oil before the market rolls over. So they are weak relative to the market. Institutions are profit taking, and those stocks are starting to roll over well before the market does. And then finally, when the market starts to crack down, the bottom falls out of these stocks because there's no one bidding for it, and the stocks have a lot of selling pressure on them.
I see. Are there any particular stocks or sectors that you see right now that are exhibiting this behavior of starting to decay even as the overall market remains fairly strong?
Well, the market is starting to get a little bit toppy this week. Typically, we don't see that type of selling pressure until mid-August to late August. Lots of reasons for it. Not going to quite get into it, but the bid remains pretty strong into mega cap tech earnings. We'll see how Apple comes out. Actually, it did. I'm looking at it now. It looks like there's a positive reaction to Apple. But tech stocks have run up so much that they are a little bit frothy, and some of those names we are starting to see some toppy price action. So you're seeing the stocks pulling back off of these highs, and they're weak relative to the market. And that would be the sector that I would be looking at if the market sets up for a short here. I think tech stocks have some pretty good downside to them.
So you mentioned in your videos that your first step is general market analysis, and you often mention fundamental viewpoints. To what degree has the tsunami of money printing in the last few years distorted normally important economic and interest rate impacts on the market? With some examples that I've seen, for example, like the Turkish, Argentinian, and Venezuelan stock markets are up 7, 9, and 75 times in the last 3 years, despite rising interest rates and collapsing economies due to massive money printing. How is money printing affecting the economic fundamentals and the analysis of the markets, or is it?
So personally, I don't assume that I'm going to be smarter than Goldman Sachs or Morgan Stanley or the big money. And a lot of the research reports that they publish, you'll often see those analysts are wrong and they're scrambling to kind of catch up. I am very aware of the fundamentals. I do a lot of research on the current credit environment and on the money printing and where the economic data points are coming in. And that is part of my market analysis, but it's more to have awareness of what the potential speed bumps might be and if there are any snags that could be coming up. But I'm not trying to predict what the outcome will be. I think that's where a lot of traders get into trouble. Instead, what I do is I use technical analysis and I watch the market. And when I start to see those double top lower highs and those breakdowns with heavy volume, then I know that there's heavy selling pressure and that the institutions are exiting the positions. So I really use the fundamentals more for awareness so that I'm aware of everything that's going on, but I use the technicals to drive my trading decisions.
So if you see, for example, bullish fundamental news that is perceived or should be bullish, but the markets actually respond negatively, do you pay attention to that as say, a key turning point where the buyers are fully committed in, and that likely this is a turning point because if the markets can't rally, on good news, then maybe a decline is in order?
So let me give you a couple of really good examples. And this, you can all verify this in my YouTube videos. I post a couple of them a week, and you can go back years and pick out some inflection points in the market and see if I got it right. But in 2020, I was reading about China and how their economy had completely shut down. Chinese New Year, streets are quiet. There's this virus thing going on. And so I was very aware of it. And I thought, this is a really big development. And that is going to catch up with our markets. But our market continued to grind higher and to make a new high. And so I was very passively participating in that rally. And by the end of February, took all those positions off, went to cash, and then I started to see the market declining. So I was aware of the backdrop, but I did not start shorting until I saw that actual breakdown. Another example would have been in the fall of 2021, we had a Fed that was going to start tightening, and inflation was running rampant. So all of a sudden, we started to see signs of selling pressure. And when the market doesn't rally into year end, that's a warning sign, because there's a very strong seasonal bias. And so all of a sudden, I start to see signs of lower highs and some selling pressure. And sure enough, by 2022, you could start seeing those technical breakdowns. That is when we start shorting. Because, and to give you another example of why this approach works is I went through the tech bubble. I went through the irrational exuberance. I think Alan Greenspan used that phrase in 1997. And by any valuation models, yes, the market was way overpriced. But guess what? It went a lot higher for the next 3-4 years. So anybody that was shorting based on valuation, they were carried out in body bags.
Yeah, we often hear the phrase "Don't fight the Fed." So, does it surprise you that we've had such a rally despite rising interest rates on rising a market rallying on low volume? How do you look at that?
Well, the volume hasn't been too bad the last 3 months, actually. It's been above average. And there have been pockets where you'll see a nice rally. And it has come on decent volume. And the price action has been very tight with little retracement. And so the reason that orderly price action is bullish is because every time that sellers try to take profits, the bid is replenished and the buyers are still there. And the reason that I believe the market has been grinding higher is we didn't know what was going to happen when the Fed started to hike interest rates, the most aggressive rate hikes that we've seen in decades. Well, the notion was this is going to ruin our economy. We're going to see an economic collapse here, and the bottom is going to fall out. And so over time, and now that the Fed is close to the end of their tightening cycle, the bottom hasn't fallen out of the economy. And so now that threat is starting to dissipate, and that's why the market bid has become strong. To your point, trillions of dollars printed. Imagine that. We have inflation and trillions of dollars have been printed. Gee, I wonder where that came from. So anyway, the money has to go somewhere. The threat of a credit crisis is starting to be diminished because we haven't seen any follow through to the bank situation earlier this year. We needed to wait a few months to make sure that there weren't any other cracks in the dam. And right now, things look pretty good on the bank side. The financial stress test came through, and the Fed feels that the banks are able to withstand any kind of major recession. And the threat of a major recession is also pretty low right now.
So then maybe the solution for all of this is to print even more money. Right?
Why would any of us ever want to work? All we have to do is print money, right?
Yeah.
So the underpinnings, they don't look good. Like if you look at credit on a consumer basis, on a municipal basis, on a state level, on a federal level. If you look globally, it's not a good backdrop. But if you would have gone on that notion and started shorting, then you would have probably been short in the year 2000. And you can't try to anticipate what is going to happen when it comes to credit and the market. You have to go with the flow, and that's the technicals are going to keep you on the right side, and the technicals are going to tell you exactly what the smart money is doing. And that's why I rely so heavily on it.
Mm-hmm. How does your general market analysis influence your various strategies of how to go long, short, and for position sizing?
That's a very good question. So in terms of my strategies, it's a matter of the longer term perspective and then the context of how the short term move fits into that longer term context. So for instance, if I start looking at what strategies we used, and we'll get into options, I would imagine, a little bit later, but if you're an option trader and you're interested because you think I'm going to talk about options, let me be clear that you get the market right, you find the best stocks, you get the stock right. If you get those two pieces of the equation right, then option trading is easy, and you could do almost any option strategy you want and make money. Some strategies will be more lucrative, they'll be optimal, but you have to focus on those two pieces because they are critically important. So with regards to COVID, when the market started to tank, it fell very, very sharply in 2020. And yes, we did short intraday, and there were some really big moves in March. But then as the bottom started to fall out, we started to see just this massive spike in option implied volatility. And we started selling puts because we were selling, I remember selling Google's $650 puts, and the stock was the stock would have had to have fallen another 50% in a month. And we were generating 10, 15, 20% returns on these stocks by selling out of the money puts, knowing that this was a gigantic overreaction and that the whole market would absolutely have to implode, and that just simply wasn't likely. So as the market started to kind of catch a bid and it started to stabilize, we shifted into selling out of the money bullish put spreads. Still some market threats, still some uncertainty on how COVID was going to impact the economy. So distance yourself from the action, take advantage of high option implied volatilities and time decay. And so, yes, the market drives all of the decision making. So, so last year, a good example, and sometimes you have to lean a little bit more on swing trading. And when we had 0% interest rates, the market would just kind of float higher. The intraday trading ranges were very, very compressed. And so you had to rely more on swing trading strategies and selling out of the money bullish put spreads. Last year, it was completely different because we had these gigantic overnight moves down, and then we had these big snapback rallies the next day. You didn't know what was going to happen. If you look at a chart from 2022, giant candles. Well, the intraday ranges were huge. There was no reason to take overnight risk. You had these giant moves intraday. All you had to do was day trade and focus on day trading.
So during 2022, with that kind of volatility, did you focus more on just going, say, very short term, as in day trading stocks, long or short, or did you also use options as a strategy during that market environment? And if so, what kind of strategies did you use?
We were primarily day trading stocks. And yes, we have traders in our chat room, some seasoned pros who were trading options. And so for intraday moves, liquidity is very important. It's fairly difficult to day trade options just for liquidity reasons, you're giving up a pretty big edge where the underlying stock always has a tighter bid-ask spread. And with 4-to-1 leverage, I prefer to trade stock. Even though my roots are all option-based, if I'm day trading, the liquidity, it's nice to be able to sell an ask and buy a bid, and you'll rarely be able to do that in the options markets because typically the other side of your trade is a market maker and they don't budge. But so yes, we will trade deep in the money options. Typically for day trades, you want to have a nice tight bid-ask spread. There are probably only a few hundred stocks that you would have the type of liquidity that you need to day trade options. You would want a delta of, say, 0.75 or higher, something that's going to move point for point with the underlying stock. And we are not at all opposed to trading weekly options because we don't plan on holding that position for more than the day. You're in and you're out.
Mm-hmm. And what about 2023, especially the recent months? What is your overall take on the market, and what kind of strategies are you choosing to reflect your disposition on the market?
So we've continued to do a lot of day trading, and the bottoming process that we really saw through March still could have reversed. We could have had a nice down leg. We didn't, but we could have. So the threat was still there. I still didn't feel confident swing trading, and the intraday moves were still very good. And the ATR, though, the average true range for the S&P 500 has been tanking over the course of the last few months. One of the reasons for that is that a lot of the uncertainty is starting to come back out of the market. So the first quarter, we're still day trading. I was just on the brink of starting to do some bullish swing trades. I like the fact that the market had put in a nice base. We had the 50-day moving average. It crossed above the 200-day moving average. That's a golden cross. That's usually a pretty good sign. But then lo and behold, about 2 weeks after I started to turn a little bit bullish, we got the bank failures from SIVB. So I've been through 2008, 2009. I thought, you know what? I want to give this a couple more months before I start aggressively swing trading. So my swing trading has been pretty minimal. We've been doing a little bit this week, but not that much. And so my market opinion right now is that, and we've got the Fed in recess. Washington, D.C. is going to go into recess once the mega cap tech earnings are done, which they will be after today. Shorts will be more aggressive and some of the air will be let out of the balloon, and everyone will start wondering, gee, is the Fed going to hike rates in September? And which, by the way, there's been quite a large bond sell-off that started before the credit rating was lowered by Fitch. And that's because the market's been expecting that the Fed was going to cut rates in Q4. And the Fed has said, absolutely not. In fact, we might raise rates, and now push is coming to shove, and we're getting closer and closer to Q4. So they're having to unwind that. Well, the Fitch news really accelerated that bond sell-off. So they're having to unwind that position. They are taking losses on that. So higher interest rates are going to weigh on the market a little bit as well as we head into the end of August and into September. And just a seasonally weak period. And after a big run, the market's going to start to soften up. So what does that mean? How do I trade that? Well, it means that you keep your risk exposure fairly light. Everybody goes on vacation, the volume drops off. Focus a little bit more on day trading and start looking for those topping signs. And so I'll be looking for a little bit of a rebound next week. I don't think that the sellers are going to completely go away, and then look for that lower high double top. And then once you have that and a nice long red bar that starts to break down and make a lower low, now you've got the makings to day trade from the short side, be a little bit more aggressive there, perhaps even do some swing trading from the short side, maybe sell some out of the money bearish call spreads on stocks that are particularly weak and breaking through technical support.
Mm-hmm. How often do you not trade due to unpredictable or neutral broad market conditions?
That is Such a good question. Oh, is that a good question? Um, that is something that I try and teach people. You don't always need to be engaged in the market, but the temptation is to always have something on. And early on in my career, some of my biggest losers would come after my biggest gains because you're thinking, oh, I'm just going to keep doing what I did before and it's going to make these monster returns. So, some of the tells, I know that you have an audience that largely day trades. So, some of the tells that you should look for if you have a low volume, choppy trading day with lots of mixed overlapping candles, it's not going to go anywhere fast. It's a low probability trading environment. If you are inside of the prior day's range, an inside day, it's going to be a low probability trading environment. If you're inside the first hour range, it's a low probability trading environment. So then you have to trim your size and your trade count, and just sitting and watching could be the best thing that you do unless you find something that's super compelling. Oftentimes we'll find a lot of group or sector rotation within the market. And then we're going to find that because those stocks are going to have relative strength or relative weakness and the heavy volume that we're looking for. And so you'll be able to zero in on those pockets and make your money there. But in general, you're trimming your size. If you have a monster move the previous day, the next day, you're probably going to have an inside day. And the market's not going to have back-to-back big days. So you should expect that if you have big pending news, like a jobs report, FOMC statement, you could lose a couple of days of trading because everybody is going to wait for that event. And so you factor that into your trading and you reduce your size and your trade count.
One of the quotes you have on your blog is, you should not buy breakouts near the high of the day. Why is that?
Well, one of the reasons is because most people don't know how to identify the real McCoy, which if it's early in the day and it's making a high, say in the first 40 minutes or so, and you have a conducive market backdrop for longs, then you can trade those, but you're looking for these stacked consecutive green candles on heavy volume with very, very little overlap. The big problem that most people have is that they start seeing that pattern in everything that they want to trade, and it's just not there. There's overlap, there's not the volume. These are head fake moves. And when you buy the high of the day, you're far from support. And so when the stock does reverse, it reverses very sharply, and you're not sure where you should be stopping that trade out. And oh my gosh, now it's continuing to reverse that entire move. So the better method is to set alerts and to wait for those dips. And when the stock dips, we want to evaluate that dip. And in particular, what's the nature of that dip? What does it look like? Are we seeing stacked red candles consecutively on that pullback? Is the volume heavy? If it is, that's not a dip. That could be a drop. That whole move could reverse. On the other hand, if I see overlapping candles, lighter volume, and the stock is able to retain most of the gains that it's put in so far that day, that's just a normal little round of profit taking. And that dip, especially if the stock retains its relative strength, is going to stage another leg higher, and you'll have that bullish flag formation, and that will provide you with a much better entry point. Plus, while you're waiting, you're able to evaluate the market strength. What has the market been doing over the course of those 15 or 20 minutes or 30 minutes? And it also encourages discipline, which a lot of novice traders, they'll shoot at anything that moves. And you really need to be able to put FOMO aside. And I've developed an alert system specifically for this so that traders can set an alert. And we use a number of different indicators. One is It measures relative strength and relative weakness. Well, a stock that has shot higher is going to have lots of relative strength in the first, say, half an hour, 45 minutes. And that percentage gain is going to be very big relative to the S&P 500. Well, eventually, it can't keep up that pace. It can't. And so the stock is going to lose some of its relative strength, and it'll dip below zero, and then it'll regain that strength. And so we set alerts, and we know that it has to go relative weak and then relative strong, and we get the alert. And when we get that alert, we look at the stock, we see if it's got stacked red candles, or if it's been a nice tiny little pullback on light volume. Then we know that's going to be a good opportunity, and then we'll take the trade. LRSI is another indicator that we use, similar premise, and that which we can also use for swing trading. Same concept applies. So you get a nice big breakout on a daily chart. You don't have to buy the breakout. That stock, in all likelihood, is going to retrace. You would use longer time frames, like maybe a M30 or a 1 hour time frame for that type of setup for swing trades.
Mm-hmm. So, but if one's looking, say, at a daily chart and they see a breakout and the size of the breakout is not obscenely large, say maybe 2 or 3 times the average true range, so it's not like one of these very long candles,
Right.
and the volume is heavy. Isn't that a type of breakout that would be conducive, say, toward near the end of the day, where you get maybe like a hammer formation?
Oh, those are really good breakouts. In fact, on every breakout, you make a good point. You want to break that on huge volume with a long green candle closing near its high versus poke, 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 poke at that resistance level. You want to blow through it. You want to obliterate it. But even then, most of the time, you're still going to get some retracement and you're still going to get some profit taking. And you may not get as big a retracement. So if the chart looks really good and the stock is not too far out of the gate, as you've mentioned, then what you'll want to do is set an alert with maybe a 5-minute or a 15-minute time frame, so that just even a smaller dip is going to trigger that alert so that you can evaluate it. 90% of the stocks, they pull back. 10% of them, they won't. They'll just keep right on going, and you have to be willing to miss those 10% of the trades. But in doing so, what you're going to realize is that for the 90% that do pull back, there are going to be a huge percentage of them where you look at it and you go, oh my God, I'm so glad I didn't chase that breakout, because that thing retraced the whole way and I avoided a very big mistake.
Mm-hmm. So let's jump to part 3 of your process, which is choosing the strategy, whether to go long, short stock or to choose options. Those who avoid options due to perceived complexity, and others who only want to do options because of its leverage, how can options be used responsibly to expand our options?
Well, again, options are the icing on the cake. And if you get the first 2 parts of the equation right, then trading options is going to be very easy for you. And what we suggest to novice traders, and this is going to dishearten a lot of listeners, and there aren't a lot of people that follow this advice, but trade 1 share. If you're starting out, trade 1 share of stock, get your win rate above 75%, do it for 3 months, and then start increasing what you do. Then and only then should you even start thinking about options or even learning them, because this is a double-edged sword that cuts very, very deeply. If you don't know how to trade and you get the market wrong and the stock wrong, there's a huge probability that you're going to lose money very, very quickly. Options will simply take you out of the game much more quickly. And so when it does come to effectively trading options, you've got your confidence up, you've got your win rate up, you're not going to get to that 75% win rate unless you've been trading for probably 2 or 3 years and put an extremely, just put in some extreme hours. You have the knowledge that you need to identify good market conditions from bad. And now you can take your trading to the next level using options. But there's no big mystery to options. It's the direction, duration, and magnitude of the move are what you have to quantify. And so if you look at all these Black-Scholes and option pricing software and models, oh, this is great, here's what my P&L can look like. Well, you still have to know what the inputs are. What is the duration? What is the direction of the move? What is my level of confidence in that move? And so those are things that you're going to also pick up when you're just working with the underlying stock. I can give you specific examples of strategies that we use when we trade options. One of the most exciting option strategies that we use, mind you, it's a very small part of what we do. So I don't want to get anyone super excited that they're going to jump in and learn how to do this, because it is the epitome of option trading. But in the last week, or the last hour of the week, Friday, we look for weekly options. We look for stocks that have extremely strong characteristics. We look for the market setup that we need. And you can buy options for a dime, 15 cents, and they can go up 2, 3, 4x even within the course of 15 or 20 minutes. But this is a very low probability trade, meaning most of them don't work out. So we really have to work on that component of it to make sure that we have our odds of success up. But it's also a very low risk strategy with high potential. But most people are going to look for those opportunities in the last hour of Friday every week. And they're just going to go in there, bing, 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 shooting around when the setup is just not there. So it's a small percentage of our trading that we do, but it's kind of a fun way for us to spend a Friday afternoon very late. And it really drives home a lot of the concepts of pinpoint precision when you're trading options, buying options. If you're an option seller, then it's kind of like instead of being a sniper, you're throwing hand grenades. You just generally have to be right. You can sell naked out of the money puts on very strong stocks that you would like to acquire, and you can generate income doing that. You still have to pick really good stocks, but that's an excellent strategy. And selling out of the money bullish put spreads when you have a decent market trend is also a fantastic strategy, because most of the time, about 80% of the time, the market is flat to higher. And that strategy is going to generate income for you under those conditions. And once we get through September, I think we're going to have a market dip. And from that point forward, I really feel that we're going to have a nice environment for many years where we can sell out of the money bullish put spreads. It's a strategy you should learn. So you don't need to be complicated with your option strategies. You don't have to do broken wing butterflies and iron condors and ratio back spreads. Just have to know how to do debit spreads, credit spreads. Selling naked puts is a good strategy to know, and then just buying in the money calls or puts. Focus on the market. Focus on getting the stock right. You get those two pieces right. That's the key.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
In some of your videos, you've highlighted some stocks that are breaking out, and that due to your cautious nature at that time, that instead of going long the stock in a breakout that appears to be looking very good, busting above the trend lines, you have put on trades, much more conservative trades bullish credit spread trades where the stock could actually fall a number of points and you could still generate a decent income of around 25%
Right.
on your position. And so what are your thoughts about, sharing a little bit regarding more conservative strategies? Because so many people have heard about if I buy this call option and it could quadruple in the next hour and I could get rich. But a lot of traders would like to understand the much more conservative way to use options as many tools in our tool chest.
Right. Well, yeah, you hit a couple of really important points. One point is I don't do the videos all the time. So for me to provide minute to minute instruction to YouTube followers, if I put the trade on and give them a level that they can lean on, and yes, if the stock breaks below this level, it would have to move quite far, and then you would want to close this trade down. It's kind of on automatic pilot. So time decay whittles away at the position, it expires. And so there's no action required. Part of it also is the warm, fuzzy feeling that I'd like to have my YouTube followers get when the trade works out, because they see, video after video that, hey, this is a really good method and it's been successful versus, and it is very, very tough to publish trade ideas publicly because you get ridiculed, you get hammered. People on social media they're relentless. It's very difficult. So part of it also is I just don't want to deal with the aftermath of, you told me to buy calls and look, they lost money. It's like, oh geez, well, yeah, if you'd have listened to the other 10 components of the trade, then you wouldn't have bought them, because there were some contingencies associated with the trade. And I usually try and identify as well, here's what I'm expecting the market to do. Here's what I'd like the market to do. If it does this and the stock does this, then I would buy these. To your point, yes, selling out of the money bullish put spreads for anyone that's looking to swing trade, I would highly recommend that they learn that strategy. It's a good one.
I'd like to transition to risk management. I've seen a quote by you where you say position sizing is way, way down on the decision-making flowchart. Why is that?
Because there's this mechanical structure that everyone wants to associate with trading, in my opinion. It's way too regimented. It's way too constrained. If I have support on the stock here, I'm willing to risk X number of dollars. And if it goes below that point, then I have to stop out. And I always need to have twice the profit potential as the amount of money where my stop is. So when it comes to position sizing and risk management, you're really looking at what is the overall market doing and what is my confidence in it. I know I keep hammering this point home, but I can give you countless examples real time of how this works. And so when you're looking at it and you're assessing it, you can identify certain instances where I feel very confident, given what I've just seen, that the market is going to do this. I feel very confident, and let's say that a bullish trend day is forming, and we have a bullish trend day within an overall bullish longer term trend. Awesome. Got two major check boxes marked. Now I have a stock that is starting to break out through major horizontal resistance on heavy volume. Okay, got the daily chart. I've got the relative strength on a 5-minute basis. So now I'm starting to enter the position. Market's continuing to do what I expect it to do. I'm adding to the position because I know I have the market conditions I want and the stock is performing as I would like. So I'm going to continue to build and add onto that position versus a situation where the market is sideways, it's in a tight compression, it really hasn't been having any kind of a trend, perhaps even like what we saw from December through February this year, chopping back and forth, up and down. I don't have a whole lot of market confidence in here. So I'm going to reduce my trade size and my trade positions. So as long as the position is working for me, in many instances, especially if I have that market tailwind, I'm going to continue to add to the position, knowing that this move has legs. It's got the potential to keep going higher. Other times, I'm not going to be adding to that position if I don't have the confidence that all of the other check boxes are in place.
What do you look for to get out of a position? And do you do it manually or do you have a preset stop?
I do manual. I have some indicators that I use. The 10SI indicator measures relative strength. So I'm looking for price patterns. I'm also watching what the market is doing and what the S&P 500 is doing. So if I feel that the market is starting to get a little bit toppy and it's starting to hit resistance intraday, I'll speak on a micro basis since many of your listeners are day traders. And so earlier today, we had a situation where the market was starting to top out. We've got a 1OP indicator that helps us judge when the market is starting to get a little toppy, but we had a double top after we filled in the gap and the market was not able to advance. I told everyone, listen, if you're in STX was a stock that I highlighted earlier today. If you're in this stock, you should be taking your profits here because the market has hit resistance. It cannot move through this. We've seen heavy selling pressure the last couple of days. We've got major news pending overnight. Got Amazon, Apple, and we got a jobs report tomorrow. You don't want to be stuck in a position kind of painted in a corner. So take your gains right now. Bullish hammers off of a relative high, bearish engulfing candles off of a relative high. Those are major signs of resistance, especially when you're making a new high of the day. So tiny compressed candles, mixed overlapping candles during the rally tell me that the rally is not that strong to start with because it has lots of retracement. So that tells me also that I need to be fairly careful and I may need to take profits earlier. What's the volume on the way up? Is the volume charging higher? Is the volume increasing? Those are all components of learning how to read price action. Those are all factors in when I'm going to be taking profits.
So I noticed that you use quite a bit of trend lines. Are you looking at multiple trend lines and to see if the stock breaks above or below these intersecting trend lines to measure the quality and the importance of going long or short that stock?
Trend lines play an important role in what we do. I have automated trend lines that I released about 3 months ago, and there are a number of different current trend lines that are visible as long as they're within a certain ATR. And so, yes, we're able to see what the stock is doing around those trend lines. Institutions are also watching those trend lines. I'm fairly confident that they have algorithms that they program so they know when these trend lines are being breached. If we see that really heavy volume through that trend line with the candle closing near its high, then we know that the institutions are accumulating, that they're also following that trend line. And relative strength is also going to be present. So yes, we use trend lines a lot. And so trend lines that are, we have different names for them, like a high minus is a downward sloping trend line that connects the highs. A breakout of a high minus is much more reliable than an ascending trend line that connects the highs, and we call those high pluses. So those trend lines are more apt to, those breakouts are more apt to reverse. So the type of trend line is also important.
Mm-hmm. So to wrap up, what do you struggle with most in trading?
Well, my trading, quite honestly, I'm kind of in the twilight years of my trading right now. I am winding down. I've made it. I don't have any real struggles. I trade when I want to trade. I'm not beating around trying to grind out huge winners every day. I'm really more focused on building trading software and on educating traders. So from a trading standpoint, just to purely come in and trade and make some money, what do I struggle with? I feel like I've been there, I've seen it all, I've done it all, but I do still have some challenges and struggles. One of them is the fact that this is a very sedentary profession. And so you're sitting for 12 hours or more a day in my case. And so getting exercise is difficult. My eyes have taken a beating, so I can't I can't watch the screens as much. As I continue to educate other traders, I struggle with patience and, kind of rehashing the common questions that come up time and time again. I also struggle with writing. It's very difficult for me to write, although I've been diligent about it, and I've got pretty close to a book. I'm about 70% of the way through it. So I don't know if you've been able to check out my educational content that's available for my members, but it's very detailed, very comprehensive. So
Oh, great.
those are some of my struggles. They're not trading related. I feel like I can trade with the best of them.
Oh, fantastic. So what's the next chapter for you? You mentioned you're working on your book.
I am working on a book. I haven't decided if I'm going to publish it or just leave it and have it available for my members. So completing that, I'm about 70% of the way through. It's taken me a couple years. So to sit down and force myself to write has been tough. I love developing software and to develop new tools that are going to help us become better traders. So I've mentioned the automated trend lines. I've mentioned the alerts that we just released about 3 months ago that help us buy dips and help people avoid FOMO. One thing that I plan on doing is when you've done a trade to be able to have a back-end analysis. So we've got custom searches and variables, and we have ones that we know should be present when we do a trade. Well, once you've done the trade, you'll be able to take a look and see which checkboxes were marked, which ones should have been marked but weren't. Then you'll also be able to go back and see when I had these variables marked and they were in place, my probability of success was much higher. So it's almost a way of journaling. And I think that a lot of traders struggle with journaling. It's just like they don't want to do it. It's like, the trading day's done. I'm tired. I'm turning my screen off. Yeah. Well, that's such an important part of trading. That's where you learn from your mistakes and where you continue to do what is working well for you.
Thanks, Pete, for your contribution over the years in educating traders. I remember watching a video of yours going all the way back to February 2008 with the simple graphics of the early internet. I mean, it was like a flashback to earlier time.
Yahoo charts. Yahoo line charts.
Yeah, exactly.
Yes, I have been doing this for a very long time. So thank you. I appreciate that. And I've taught a lot of people. And right now that's kind of where I find my greatest joy is knowing that I've been able to share my passion with others and to help them.
Great. How can our listeners get in touch with you?
www.oneoption.com. You can spell the word one out, or you can use the number one. If you do that, you'll find all my social media. You'll find your way to our website, and you don't have to buy a thing. Learn the system. And on the website, there's so much information on the system that I've just been describing to you and why it works.
Great. Thanks again, Pete.
My pleasure. Thank you so much. I really appreciate the opportunity.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
So let's ask the question. Let's turn this back around. If we said to most newer traders, if we said, okay, for you to enter into the trading world, it's going to cost you $25,000 to $30,000, and it's going to take 2 to 3 years of your life minimum. How many would then follow through? I'm guaranteeing 90% would probably pull out.
Markets, speculation, and risk. This is the Chat with Traders podcast.
We're in episode 266. Welcome to Chat with Traders. I'm Tessa, your co-host. I'd like to introduce our next guest. You heard him earlier. That awesome Aussie accent belongs to Mark Bunnell, an engineer at the core switching to full-time trading for the last 15 years, breaks down what it means to treat trading as a business. We hear that all the time, but what does that mean really? And why this mindset was incredibly important in turning his trading around and why it has kept him in the game for this long. Mark's mainly a discretionary swing trader and scalper of the Australian equities and forex markets. He's presented for the Australian Technical Analysts Association and appeared in the Trader's Edge magazine in Australia and has a lot to share with us today. I don't think you want to miss this, guys. By the way, I'm filling in for our host, Ian Cox, today. Ian's trying to squeeze in some more mountain biking as the summer weather is running away from Seattle. So I said, hey, I got this. Ladies and gentlemen, I'm so pleased to present Mark Bunnell, all the way from Australia. Hi, Mark. Welcome to Chat with Traders.
Hi there, Tessa. Thank you, and nice to be here.
Where did you grow up and where are you now?
So I grew up in Melbourne, Australia. I've been here all my life. I enjoy it here. I love it here. Have a background in engineering. Started right from the drawing board through to technical sales engineer, project manager, and then finally worked my way up to general manager. So I love that career. I enjoyed that. I miss that at times. However, I've now been trading the markets full-time for 15 years. So yes, then traded for 3 years part-time while I was a general manager. Did quite well there with some early Elliott wave knowledge, Elliott wave theory, and that completely resonated with me. So I thought I had found a bit of the holy grail, and so I applied that. In my third year part-time, I returned about 60% on my trading account. So naturally, I was thinking, why isn't everybody doing this? Of which I was to find out very soon. So that kind of set me up for not a fall, I wouldn't say, but that gave me a false sense of what trading was about, because I don't know whether listeners are aware, but here in Australia, we're very resource dominant, and we had a very big bull market in resources. So you could have taken a handful of darts and thrown them at a handful of stocks and made money. So look, I like to think there was a bit of technical skill in there as well, but really, it was a product of the good market conditions, the bull market as well. So that was my early sort of foray into trading part-time. My father got me into part-time trading as another source of income and a source of wealth. And so, look, from that time on, I thoroughly enjoyed it. Bought a couple of decent programs and started my sort of trading career from there. But unfortunately, well, not unfortunately, I suppose, but my wife at the time and I left our jobs. This is 15 years ago for a change of career. And I thought I would try trading full time. And right at that moment in time, or round about that moment in time, was when the GFC hit. So that was when I realised what I didn't know about trading. So I took a decent hit. It completely caught me off guard, blindsided me. Prior to that, I was able to take losses and things and, follow my plan. But, when we had such big periods like that, I just didn't know what to do. I didn't know how to stay out. So that was my early experience trading full time.
What is the JFC?
So the global financial crisis of 2008, 2009.
Oh, I'm sorry. Okay, so that's an acronym.
It is, yes. So, okay. And I'm sure a lot of listeners would remember that. And look, in one sense, though, it's probably good to have gone through it then than when I had serious and big money in the markets. It's good to have gone through that sort of situation early on and be able to work through it. So I see that as a plus. I see that as a positive. So I went about educating myself. I did quite a bit of formal education. I have the CFTE qualification, the Certified Financial Technician. I did the Diploma of Technical Analysis here in Australia, as well as the Diploma of Share Trading and Investment, as well as a lot of other self-directed study and other short courses. Some good, some not so good, but I tried to take away from all of that what I could. So I really gave it a good shot. Plan B, I didn't even want to think about going back sort of into the corporate sort of world. I didn't want to think about that. But I committed myself to trading, 12, 13 hours a day to study and learn for 3 or 4 years. Spent that, did the formal education. That was about 2.5 years. Got a lot out of that. Gave me a huge, terrific foundational knowledge base that I can fall back on. But then came the time, of course, to start working on your psychology. So,
can I back up just a minute? What kind of engineering were you exactly? Was it mechanical, civil?
So, mechanical, but the company that I was general manager was more civil based. Sort of worked my way up. And I mean, look, when I think my skills was more in managing staff, and throughout working those various roles, I was able to put together a lot of create my own sort of procedures, my own those checklists, my own sort of checks and balances here and there. And that gave me a terrific grounding, I guess, for that sort of role and for my role to come, which I didn't see at the time. But I guess coming from that sort of mathematical engineering sort of background, we are wired a certain way. We're very detailed. We're very analytical. We love charts and statistics, that sort of thing. We love to add more moving parts, sometimes to our detriment, of course. But that's one thing that we have to be sort of careful of. But certainly from the process side of it, yes, that's where it's really come in handy. So yeah.
That what drove you to also get those certifications or diplomas that you mentioned? related to trading?
Great question. So when I went into the market and got hits, when I started trading full time and encountered the GFC, naturally I thought that this is a result of me not knowing enough. So then I thought, all right, me being me, I'll find out as much as I can and I'll beat this thing. I'll beat this market by getting as much knowledge as I can. Knowledge is power. So I thought, and yes, look, it certainly helped, but it's not enough. So that was my thinking at the time. I don't know enough. Of course, when you have that thinking, it's easy to be in search of the Holy Grail and to continue in that mode for quite a while. And I've got to catch myself the odd time.
It's, interesting because it's very different from the corporate world. When in the corporate world that you were in, you can, get additional degrees and get all these certifications related to your work, your corporate day job. And that most likely will help you move up. But whereas in trading, it doesn't guarantee that at all. It's just a completely different mindset. What was it about the corporate world that you knew it just was not for you, that drove you to trade instead?
Okay. And look, yeah, great observation there. And you're absolutely correct. Look, out in the rest of the world, the corporate world, the more we know, generally, the more we get paid. And that's not the case with trading. The markets don't care how much you know. It's how well you can apply that, of course. Does it help to give you edge? Absolutely, it does. But there is kind of a limit where the more you know sometimes can be actually detrimental, but because you can easily get into that sort of analysis paralysis situation. But certainly bigger picture, yes, absolutely. But once you know, as I think it's Bruce Lee says, once you know, you've got to apply. You've still got to start to apply what you learn. Otherwise, it is just a whole heap of knowledge. It's no different to let's give an analogy. It's no different to the medical student that knows how to perform the operation in theory, but he's never done it. So I think that's a great analogy. So you have to then start practicing, and that's when the real lessons come. And that's obviously also learning about yourself and starting to know yourself and work with yourself. That's the key to it.
When did you make your first live trading, and what types, what were your strategies like in your early trading?
Certainly. So in my early trading part-time, it was very much swing trading. And being here in Australia, I swing traded our Australian stock market. So that was my sort of style, anywhere from a 2-day to 2-month hold, based off a monthly, weekly sort of daily charts, more weekly daily charts. Something that I didn't need to monitor. I could just look at once a day, perhaps just keep my eye on it during the day. But yeah, very much a swing style, very much based on Elliott Wave, very much based on pullbacks or bases out of wave 4 and into sort of wave 5.
Did you swing trade because you were still working full time and that just kind of worked well with your schedule?
I did, yes. Yeah, I couldn't trade during the day, and obviously I didn't want to at that stage. Well, sorry, I might have wanted to, but I couldn't. So it really was just checking afterwards, running my scans and making decisions. So probably half, 3/4 of an hour a day was what I did, and a little bit more on the weekend just to do some reviews and that sort of thing, and weekly scans. But no, it was very much part-time.
Have you gone through some really rough periods during your trading, and that probably has something to do with, losses, or maybe just the time it takes to understand trading? Can you share a little bit about that? Perhaps your darkest moments in trading, and what was the pivotal moment in your trading career that led you to remain in it for 16 plus years now? I mean, you are obviously doing something right to still be in it for this long. Would you be willing to share a little bit about that?
Yes, absolutely. So during the learning curve is the time where, and depending on individual's personality. I'm very critical of myself. I'm very very driven. So when you're not getting success, of course, it leads to not necessarily feelings of failure, but feelings that you're not getting there as fast as you would like. So I think, so what I did, I'm not necessarily a person that gets depressed, but I think it's more, it gets you down a little bit, but it's what I then did with that. So I learned from that and tried to sort of come out of that being better for the experience, because I allow that to sort of teach me, okay, this is where I'm at. But there was times where, certainly in the learning curve, I'd given myself that time and financial buffer, and my wife at that stage, she'd taken time out as well to reinvent herself. So we were living off our savings. So that's always in the back of your mind. And of course, in the back of my mind was that, trading with scared money. That was another thing as well that can affect you, and did affect me as well, even to the point where I thought, look, I need to just go and find a part-time job. And I did try and find, part-time engineer assistant or any sort of job just to take that pressure off. But it's hard to find those sort of roles. So no, I pushed through. I took a little bit of time out, but I think sort of pressing into work helped me get through it. Helps me to alleviate those sort of feelings of being down, keeping healthy, plenty of time in the gym, get those frustrations out. And as I said before, you'll always have those blips in your life. It's what you do with that, and it's what I did with that. So I use those opportunities to sort of regroup, refresh, and come out of it come out of it better for it. And in the back of my mind always, though, was, and thankfully with some of the early education I did and some of the people that I sort of listened to, I knew that I was in that. I knew how long it was going to take. I was aware of it. You just don't know, first off, when you start. It's the old saying, we don't know what we don't know. But I knew that it was something that I wanted to push through, and I knew that it was something that I wanted to achieve. And there's an old saying where if you want something bad enough, our brain just figures ways to get around those obstacles and makes it happen. But a lot of journaling helped me through, and to know that when I look back on my journals, to see where I'd come from certainly helped me to realise that, okay, I have come a fair way. I've got a huge knowledge base here, and it's just now a matter of applying it as best I can, and also finding out what sort of styles suited me. So yeah, look, I hope that's sort of answered in a bit of a roundabout way.
Yeah. So do you remember any kind of specific aha moments that really turned your trading around? Was it maybe a strategy that you developed that had an edge, or, you said you journaled a lot, so that might have helped you discover, what you were doing right, what you were doing wrong. What was your aha moment?
One of the aha moments was to now be to change my thinking to, number one, in terms of a business, which we'll get into in a moment, but more not to trust my first thought, and to have plans and other things and resources and routines to protect myself against myself. That was probably the biggest aha moment, was now realizing, this was earlier on, realizing that I can't trust my initial thoughts, and that we're not naturally hardwired to trade. So beginning to rewire myself to be able to think like a trader and think in terms of a series of trades was one. That certainly helped me to not take those small hits, when I say small losses, those individual losses, those moments, to keep them in perspective of the bigger picture, where it's just one trade, it's just one. But that now starting to really work on myself, really journal really work on myself, not trust those first thoughts, think about what I was thinking about as one removed, I guess, somebody thinking about what I'm thinking about. That was kind of probably the turning point where now I was able to start to work on myself. And that came early on once I started to apply my knowledge. At the end of the day, you realize what it is. You realize it's yourself making, this wrong decisions, poor decisions, impulsive decisions. And you either now work on yourself or you find something else. So this is when the real work begins.
Yeah. So you brought up the topic of, we as humans are not hardwired to trade. This is a topic that we're going to dive deeper into, which is treating trading as a business. And I want to start off with what, kind of from my perspective, I think that the barriers of entry to trading is very low versus opening a traditional business. And my point is more that I think that there is more of a gambler's mindset for a lot of people going into trading, since the barriers of entry is quite low for trading, versus someone who has, say, an entrepreneurial mindset and then going into like a typical business. And therefore, I think it plays into the statistics, the alarming statistics that 20% of small businesses fail within the first year versus 70% of traders fail or give up within the first year, according to some sources. So what are your thoughts on that?
So let's ask the question. Let's turn this back around. If we said to most newer traders, if we said, okay, for you to enter into the trading world, it's going to cost you 25 to 30,000, and it's going to take 2 to 3 years of your life minimum. How many would then follow through? I'm guaranteeing 90% would probably pull out. And look, I was the same. You don't realise what is involved in trading. And unfortunately, you hit the nail on the head. The cost of entry is very low. So we go into this profession ill-prepared for what's ahead. We're in the markets against, bigger funds, bigger central banks, bigger traders with huge accounts that can move the money, and we think we're going to go in there and start to nail it with 3 months experience, a couple of weekend courses, and a 10 grand account. It's just not going to happen. So if you told traders what's actually involved, those that wanted to begin, I can guarantee, as I said, 90% would not follow through. And that's the trouble. We just don't know what's involved in getting skilled. And the analogy that I give, of course, is the engineer or the doctor. You're going to do, the medical student, you're going to do 3 to 4 years, whether it's over a part-time period of 6 or 7, whatever it is, you're going to do your time. Another way I say it too is you're going to pay your tuition to the market one way or another. Either do it smart, educate yourself, do it properly, hire a mentor, do it in sequence, or try your luck. Go in there, try your luck and do it ad hoc. And unfortunately, that's part of how I did it. Because I didn't have mentors. So there's the option. So I think if we presented that to most newer traders, I think, yes, that would cut a lot out. Absolutely.
Mm-hmm. And so, we hear a lot about on Chat with Traders as well, on the 260 plus episodes, maybe about a dozen of those episodes or more mention the word or mention the phrase, one of the keys to their success is that they treat trading as a business. And we hear that a lot. But what does this actually mean? I don't think we've ever really took the time to really break this down. What do we mean, or what do they mean when they say they treat trading as a business? Do you have to have a business degree to do this? Or when do you start doing this? When you first start getting into trading, what does it mean? So I hope that maybe you can help break down what does it mean when we need to treat trading as a business?
Yes, absolutely. Great question. And if we said to, as just to back up and reiterate what we said before, if we said to people, you need to be qualified, you need to have done your study before you're even allowed to place one trade, that would cut a lot more out again, wouldn't it? So, look, one of the keys, and those that are successful are treating trading as a business in some way, shape, or form. Does it mean you have to have business skills? Does it mean you have to have an MBA? No, it's not. And that's, you can get into trading with no qualifications at all. You can get into, do you need to be exceptionally skilled, gifted to be successful at trading? No, it doesn't come down to that. Learning strategies and other techniques, technical analysis is the easier side of it. It's working with ourselves. So in some way, shape, or form, you must be treating trading as a business. So let's consider those that treat trading as a hobby or those that treat trading as a true business. What does a hobby generally do? A hobby, yes, it brings us pleasure, but it also costs us money. So when people are treating trading as a hobby, they're really not treating as a something serious. It's more something that they enjoy, something that they like to do, win or lose. Maybe it's fulfilling that desire to be using their time towards something that they think could be something down the track. But by not starting with the right mindset in terms of treating it as a serious business, can actually be quite detrimental, because it never allows you to sort of work on the things you need to. So let's liken and let's have a think about other business endeavors. In other business endeavors, and let's liken it. We'll sort of come back to comparison with trading. But in any other business endeavor, if you were to put in 50, 100, 500,000, would we be using and would we be making the undisciplined, impulsive decisions that we make in trading? I doubt it. If you invested the time that you invest in trading into other businesses, we would take it more seriously. So when you can see those parallels, I think you'll find if you invested in some other part-time business, I can guarantee you would take it a lot more seriously. So why is it then with trading that we are so undisciplined? It's because, we're not taking it seriously. We're not treating it as a serious business. Let's say, and also too, you have to remember, if we have a business that we've put 100,000 in, we want to get a $500,000 bank loan to buy additional stock, whatever, and we approach the bank for a loan, we need to have a business plan. We need to have something to go to the bank for them to lend us money. Otherwise, they won't. So same thing with trading. If you wanted to trade with a margin account, you should have to come up with a business plan. So when we liken it to other businesses, we can see that a lot of people don't take trading seriously. Now, let's consider trading. And I consider that trading is a serious business. We've got a serious financial commitment. We're perhaps trading with the family's life savings. So we have a serious financial commitment. If we're putting in an hour a day and a couple of hours on the weekend towards our reviews and journaling, that's a serious time commitment. We're emotionally involved with our trading, so we have an emotional commitment as well. We're thinking out our trading. We're working on ourselves all the time. And often there's going to be sacrifice will be required to commit to your trading. So trading is a serious business.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Let me back up. Why do you think, people are not taking trading seriously, yet when they're trading, it can have very serious consequences with losing a lot of money, but yet they're not taking it seriously from the beginning? Is it because the barriers of entry, is that a factor also? It's so easy to get in.
I think so. No, I think that makes us not take it seriously. If, as we said before, if we said, right, a minimum of a year and a half to 2 years learning, and you need to come up with $25,000 deposit, let's say, just to be able to have the privilege of putting a trade on, how many people would go through with it? So if we made those entries, those barriers to entry stricter, yes, that might make people take it a bit more seriously.
Mm-hmm. And then you mentioned something I thought was very interesting is treating yourself like an employee of the trading business. What does that mean?
Absolutely, great question. So let's think once again. Let's fall back on our traditional business. Let's consider employees of a business. So an employee, you're employed by a business, you have to have responsible behavior. You have to be accountable to somebody. There's going to be performance reviews, regardless of whether you're sales or management or whatever. There's going to be performance reviews. When a new employee is hired, we give them a job specification so they know what to do. And a lot of times the individual's told, don't think, just follow the specification. So you can see we're given a set of instructions. And often the employee will be reprimanded for deviating from that specification, and there could be possible termination for non-compliance. So that's in terms of a traditional business. Now, when we think of our trading business, well, who are the employees? We are that employee. Now, who are we accountable to? I think it should be, if we said before, if we're trading with the family's money, if we're trading with the family's life savings or part of, well, we're accountable to that family, aren't we? So when we sit down and do our performance reviews, maybe we should meet once a month, with the family, and we need to give a review of our performance for the month to our family to justify why we should keep our job, or should we maybe be getting a written warning or a verbal warning. Can you see how this is all working towards trying to change our mindset to being a bit more responsible for the finances? So if we were to think in terms of that, we're the employee of the trading business, and look at maybe in a family name, we are that employee. So we need to be able to think like that employee. We need to be accountable to somebody, accountable to the family. If you've got a significant other and you're trading with money, I think when we can see it that way, that can help to sort of reframe and to sort of change our thinking.
Now, if you don't have a family to be accountable to, or you can't talk to your family, and you don't have friends that get what you're doing, what do you suggest?
Okay, so let's be accountable to our future. So where do I want to be in the future? So let's keep that big picture, that personal big picture in mind. And are we following our plan and our goal for our future? Are we keeping in line with that? If we're not, and we're just being a bit haphazard in terms of our learning, a bit unstructured, how is that? How are we being accountable to ourselves and where we want to be in 5-10 years' time? Maybe something like that. Or if you want a partner in future, are they going to take someone on that's been dabbling in trading for 15 years and really not getting anywhere, as a part-time job just to keep their head above water? Are we accountable to that future partner? Whatever works, I guess. When we can start to treat trading and we start to begin thinking like a business, what it does, it reframes our mindset to begin to think about our decision-making more from a business perspective, okay? To give you an example, every decision we make, now I know if you're a scalper, we're making quick decisions, of course, but it could be a session, decision over a session, but I try and think, is this decision I'm about to make, is this in the best interest of the trading business? So that helps me to remain a little bit more objective. What that does, it builds in that accountability to, who am I accountable to? And also, importantly, am I being a good steward of my finances and my time? We have to think of time as well. Time is a commodity as well. So, when you can start to begin to think like a business, it starts to mold and change your thinking to one of, I'm part of this business, I'm part of this trading business.
Yes. And talk about once you reframe your mind to think from a business perspective, every business has goals. You have a vision, mission, and goals. Does that apply to trading as well?
Absolutely. So when you're trading as a serious business, so any serious business has a vision and a mission for that business, doesn't it? So that should be part of our thinking and it should be documented. A serious business has realistic and achievable goals. Now, they can be short-term goals, medium-term, long-term goals, but they need to be stated. Employees need to be aware of that. When we can treat trading as a serious business, what it does, and the whole idea is to shift our mindset into one of a growth mindset. So what I try to do is create, and part of that is then to create rules of engagement where, as we said before about the employee and their job specification, I try to create rules of engagement which are pre-thought out if-then statements for every situation. So if this occurs, then I do this. And how do we do that? We do that through our trading plans. We do that through our daily routines. We do that through daily journals. We do that through our trading psychology plan. And we also do that through our honest performance review process. How do we do that? It's through our journals. Journals are an incredibly important part of what we need to do as a trader. And any business they would have reviews, of course, wouldn't they? Maybe not journaled, but somebody would be taking, meeting minutes. So taking minutes of those meetings. So it's working towards treating our trading as a serious business. And of course, one of those should be to start to document your trading business plan, which we can discuss when you're ready.
Yeah. So you mentioned several plans. You mentioned the word trading business plan, and then there's also the trading plan, and then also trading psychology plan. There's a lot of plans there. What are the differences between those three plans?
Absolutely. We're doing a lot of planning. So one of them, a business plan, we need to think it's a business plan for trading. So that's the I guess the umbrella document that the trading business operates under. That's different from a trading plan. A trading plan goes in the specifics of our trading, whereas the business plan is that overview document. And what it does, it creates the framework, the rules and guidelines from a business perspective that the trader needs to operate within. So from a business perspective, not those individual trading rules that we work with, but it creates the framework that the business can operate under. So what effectively this does is when you create a trading business plan, as I call it, as against a trading plan, and the two shouldn't be combined, what it does, it documents our thoughts for the trading business. And in the process of documenting our thoughts for the trading business, it forces us to seriously think out what it is exactly we want from the trading business. So, and this, of course, should be, your trading business plan should be a fluid document. It should evolve as the trading business evolves. And a lot of people get sort of started and they don't know where they can't finish it. That's fine. You need to make a start. You can fill it out as you go forward, and as long as you make that initial start, you don't need to have been in business. You need to start documenting what it is that you want from the business, how it needs to operate. And it doesn't need to be a war and peace novel. It can be 2 to 3 pages long. I mean, my business plan is 6 pages. That's it. It doesn't need to be overarching. And if it is too long, you'll never use it. You'll never do it. Once you put it together, of course, too, you need to revise it every 6 to 12 months to see whether it's still relevant. Number one, still see whether you're working within those parameters. So the trading business plan is an important plan. And then, of course, that guides, of course, your trading plan. So your trading plan comes under the trading business plan as a supplemental document, I guess we could call it. Then you may have your specific checklists, let's say, for example, and then you may have a trading cycle, or I suggest you should have a plan for your psychology as well.
Yeah, never heard of a trading psychology plan. What does that look like?
Yeah, absolutely. So just as a trading plan, where do I enter? Where do I get out? How do I trail? What are the setups that I use? It's dealing with the mechanics of trading, I guess. It's dealing with the process of trading. But where does anybody deal with the emotional responses we're going to get on a daily basis? You rarely hear this. So my suggestion and what I do is to create a trading psychology plan where I can deal with things that come up with my psychology. How do I deal with it? What other resources do I use to deal with my trading psychology? And it as well doesn't need to be too long. It needs to be maybe 2 to 3 pages as well. Mine's 3 pages. But it covers off, what do I journal? What are the things that I include in journal? How do I deal with when I get emotional responses? What do I do? What's my plan? When I come up with a situation, when I come up with a response, how do I work through that? So there's got to be a plan, because when we're working as traders, once we know our setups, once we believe that we're skilled enough to jump into trading, and just as a sidebar here, I often get asked, do you need a high level of technical analysis trading to be successful? And the answer is no. You just need to be able to read a chart properly. Now, that will take time, but you don't need that level and that degree that I went to. Does it help me? Yes, absolutely. My bigger picture work. Does it give me increased edge? Yes. But is it absolutely necessary? No, it's not. So then the real work comes, and where the rubber hits the road is working on yourself. And I liken it to peeling layers off an onion. You peel one layer off and it exposes another 5 layers, of course. So you've got to have a plan to work through those layers, work through those issues, because otherwise, once traders start to begin to trade, generally they'll come up with easily 5, 8, 10 things that's wrong. So how do you work with that? That's where your trading psychology plan comes into play, where you can work through it 1 or 2 at a time and get through it using a process that works. So I hope that answers that one.
Yes.
For you, Tessa.
And in the business plan, what are some of the really key things about the business plan that many of us don't think about?
Absolutely. So yes, you need to have a plan for your business plan, or a structure. You need to have topics. And as we said before, don't make it huge and overarching. That just will tire you out. Don't get caught up in that trap. So some of the topics that should be covered, and these are the topics that are in mind. Number one, we need to have a vision or a mission statement for the trading business. So what's the desired long-term, now in regards to this, what's the desired long-term outcome for the business? What do we expect to achieve from the business? What do we want on a personal level? So this comes under our vision or our mission statement. So let me give you some examples. It could be a part-time supplemental income. This could be our vision. It could be a satisfying and rewarding full-time role and full-time income. Or it could be providing finances for other pursuits or philanthropic reasons. So have a reason, have a why. So that would come under our vision or our mission statement. Now, goals and objectives. So what are our goals in regards to utilising our talents and our strengths? What are our goals in regards to skills? Do you want to be a very skilled short-term trader? Do you want to be a very, skilled technical analyst? Is that part of what it is? Now, just remember too, being a qualified technical analyst and trader is 2 different things. You need to put both hats on at various stages, or take one off and put the trader hat on. So it may be that you want to be very skilled at chart reading. You're able to do that, and somebody else may trade on your behalf. You only find that down the track, but that may be one of your skills. You need to state that. What are our goals in regards to processes? Do I want to be the process management king? That should be a goal. What are our goals in regards to risk management? What are our goals in regards to investment of time? What are our goals in regards to our psychology? So that's goals and objectives. Another way of framing that, I suppose, is let's consider it from a different angle. What would succeeding at trading mean to you? So what would it mean on a personal level? What would it mean on a financial level? What would it mean on a psychological level? So if you can answer those questions, that will help, because what we're trying to do here is project forward where we want to be, because there's an old saying, when we can create that ideal situation, that ideal moment in time of what we want to have achieved, then what we focus on, we generally move towards. And as I said before, our brain then naturally, because we're problem solving, it will work ways to get around those obstacles and get what we want. So a lot of times with trading, it is only a matter of putting in the time and the effort. If we want it hard enough, we'll figure out a way to make it happen. A lot of traders, and I know this is digressing a bit, a lot of traders simply don't make it because they can't last the learning curve, or their finances run out. So I think one of the keys is to be realistic in terms of as long as it takes. Realize where you're at on your journey, okay? I know it's a 3 to 4 year degree. I'm in year 2. Okay, so realistic in terms of where you're at. Otherwise, we all want it now, and of course, it's not going to trade. Trading success will happen when it's good and ready. So another thing we should be doing as part of our trading business plan is we need to assess the trading business from where it's at in terms of resources, our finances, our capital expenditure. what's our time allowance now? What are our finances? What are we allowing for finances now? What's our level of education? What's our level in the future? Where do we want to be? In terms of capital expenditure, what are we invested now? If we're working off a 10-year-old laptop computer and we're working, on the somewhere noisy, we're not serious about, our capital expenditure, are we? So, what are our goals? If we don't have the finances, consider where we want to be. We want to have our own little quiet office. We want to have a decent setup with maybe, 2 screens, something like that. So, state what we want to achieve. Assess our level of mentoring. Assess our current levels of skills. Be honest with where you're at. Be honest with where you want to be. And then that sort of leads into, of course, the SWOT analysis.
For those that aren't as familiar with SWOT analysis, explain real quick what that is and how can that help in your business, in your trading business plan?
Absolutely. So any good business will do what is called a SWOT analysis, SWOT. So that stands for what are the strengths, what are the weaknesses, what are the opportunities, and what are the threats to that particular business. So this is forcing us to now be realistic of what's up against our business, but also what opportunities are there to our business. So when we look at each of these on its own, when we perform our SWOT analysis, we're really doing the SWOT analysis, number one, on our business from a finance and resource, capital expenditure point of view, but really we're doing a self-assessment SWOT, aren't we? So what we're doing is we're identifying, number one, the strengths of the business, as we said before, against our, what computers we use, what programs, what skills, but more so when we conduct the SWOT analysis, it should be on our personality or our character and what can be used to the fullest extent. So what are our character strengths? Now, we just mentioned before, and I mentioned about myself, very detailed, very analytical, very thorough. So my strengths will then come from planning out a trade. So when I can swing trade, I'm very good at planning the trade out. I'm very good at putting the analysis down, and I've learned not to overanalyze and get into that paralysis stage, but I'm very good at analysing, picking up, those opportunities, because I'm using my own natural skills, natural strengths. So it's important to do that from a potential trader's perspective. Let's give another example where the individual may be very good visually, may be able to make decisions very quickly, may be used to action, may be a good video gamer. So what's going to be his strength? It's probably going to be that quick decision making. So he or she is probably going to be more suited to then shorter term trading, aren't they? Because sitting down doing 5-10 minutes of analysis on a particular market is going to bore them. So you know where I'm going here. So that individual would be better scalping. Now, that is takes a lot more time. And to give you a bit of an average, it takes about 18 months to 3 years for a swing trader to be consistent. Scalper, it's more like about 3 to 5 years. So as long as you're aware of that, if somebody is very good at gaming, then yes, they may be more suited to that shorter term type of trading. Not going to get into how you've discovered that. That's I've done workshops somewhere for that, which we can talk about later. But that's part of identifying your strength. How really comes down to trying. But knowing, for starters, this is how I'm wired. That can very much help, and that comes from your SWOT analysis. So we've done the strengths. So then we need to do the weaknesses. So let's identify the weaknesses of the business. So what are the business weaknesses? Maybe not enough time, maybe not enough finances, maybe our setup is not quite as good as we'd like. And so they're the weaknesses of the business. Maybe our internet connection is not ideal. So they're the weaknesses of the business, but then we need to look at the weaknesses of our personality. So if you're impatient, trading is going to just absolutely amplify that, okay? So just remember this, that whatever our weaknesses are in terms of our personality, trading is going to absolutely amplify those to the point where they're going to basically stalk us at every turn. So you need to be mindful of that. What are the weaknesses? Yeah, I'm impatient. I can't hold a trade. Be aware of it. Have thought this out so that when it occurs, then you'll know, okay, this is part of my personality weakness. Then identify the opportunities to the trading business. If you're an FX trader and you're in London or the US time slot, that's a great opportunity. That's a great time. Or if you're here like I am in Australia, where we've probably got one of the not an ideal time slot. However, London Open, US Open occurs maybe 5 p.m., 6 p.m., 7 p.m. onwards. So if you're an FX trader, that could be ideal because you can put that hour or so in after you get home. So that could be ideal. So that could be a good opportunity. So that's the O. So we've done S, we've done W, we've done O. So the last thing is identify threats to the success of the business. What are your perceived threats to the success of the trading business? One of those could be running out of time, running out of finances. It could be lack of time, as we said, but it could also be black swan events. It could be other threats that could threaten the success of the business. Start to identify these and start to document these.
I think the SWOT analysis is really powerful. I think also it's very hard to do, especially when it's hard for us to do a self-assessment because it forces us to really face some of the hard realities when we go through a SWOT. I have a business background, but I find that treating trading as a business in general is really hard to do. So I can imagine how hard it is for many, many traders. And so what do you think would be maybe some ways to overcome that kind of feeling that it's overwhelming or so daunting? I mean, what are some actionable steps that a trader can take to feel like it's doable and they can take one step at a time?
It's no use doing the SWOT analysis unless you're honest with yourself. It can seem daunting and overwhelming. My advice to that is break it down into chunks. So chunk it down. So have short-term goals, have medium-term goals, long-term goals. Have an action list. Any good business has an action and a task list. Break that action list down into short-term, medium-term, long-term. In other words, what is most urgent, what is medium urgency, and what can generally sort of wait. Break it down so that these are the things I need to get through, work through one at a time. Otherwise, you're correct, it can be overwhelming and it can be daunting when you think about it as a whole. What I find is when you've got a project or when you've got anything, break it down into workable steps. Work on one thing at a time. Do that thing properly. Do that particular task item properly until you've mastered it. Because with trading, if there's certain things that you haven't mastered along the way, it can often be those things that actually trip you up from being successful. So a lot of times you need to come back to that and say, all right, I haven't dealt with my journaling enough. That's what's tripping me up. I've got everything else right, but my journaling is bad or my statistics are bad. Learn to master each step as you go through. And it can be daunting, but make a start. remember that trading execution, placing the trade, is just one part of the trading business. There's a whole heap of other things that we need to be doing to make it successful. And I don't want to make it sound like this is just something that you've got to be exceptionally skilled or knowledgeable to do. That's not it at all. I think the key to it is to make a start. Start to change your mindset, as we said before. Start to be accountable. Start to change your mindset. Work on one thing at a time. Start to put it in action. Start to document it. Start to put it into action. Start to change your thinking. Start to and what that in turn will do is to start to make trading more important than the hobby may be. I'm probably not putting that as succinctly as I can. Trading will start to take a little bit of a different importance, I guess, is what I'm trying to get at, where this is serious. I'm putting serious time in. Would we put serious time into anything else to really not have gotten anywhere after 3 to 4 years? That's probably what I'm getting at. And I think along the way as well, what's important is celebrate your successes as you do. Look back, celebrate your successes, because I think after 2 to 3 years, if you can look back, certainly look back through your journals, you'll realise, well, hey, I've actually come a long way. Whereas it's easy for us to focus on the negatives without realising exactly how far we've come. To give you an analogy for that too is, if you're not doing your journaling or haven't looked through your trade journal for a couple of weeks and you've taken a bad loss and you've journaled it, you think, oh, and you feel terrible. Often when you look back and have a look at your equity curve, it's not as bad as you think it is. We always seem to flick to that worst case scenario.
Yeah, I think that's a great point. I think it's important that we're aware that as humans, we just tend to focus on the negatives a lot, especially in this day and age. There's just a lot of negativity, and we forget the positives and forget our wins, and we have to be kind to ourselves and remind ourselves of our accomplishments and wins, no matter how small. It's really important. It's also, I feel it's very important too to build that confidence. It's so important to have that confidence to keep you going. And so, yeah, thanks for reminding us to look at our journals. And you bring up journals a lot, and I think that's really important and something that have been a big part of a lot of traders that have become successful because of the journaling. So at what stage should we be thinking about treating trading as a business? Say for a beginner trader who's going into trading, they're not thinking about this right now because they're just trying to learn and trying to explore trading. There's just so much to think about. I mean, would it be more appropriate to think about trading as a business maybe after a certain amount of time? Or are you saying that this is something we should know right away, that we should, set up right away?
Yeah, great question. And let's go back to the traditional business model or example. If we were looking at a business to buy, let's say, we would do our due diligence. We would do our research on that business. If we were serious about it, yes, we'd look into the particulars of it, but it wouldn't be until we'd actually purchased and then learnt about the workings of it. Until then, we'd start to put together a business plan for growth and whatnot. So anyone learning to trade and thinking about trading, no, I wouldn't put together the business plan until such time as the individual realizes that, yes, I like this. This is for me. I now want to be serious about it. I think too early on, it's just going to bog the individual down with unnecessary detail. Once somebody likes trading, once somebody has not early success, that's probably not right, but once they look into it and think that this is for me, this is something that I want to give a go, then I think you need to then have a plan as to how you work through it. I think acknowledging, and part of that is to acknowledge and realize that trading's a serious business, serious financial commitment, but also realizing that to get successful at trading, and if you can do it early on, where we realize that this is 3 to 4 year degree, I enjoy this, I like this, I want to give this a serious go, then is the time. Otherwise, if you're just dabbling in it, you're just having a look at it, no, you're not going to want to do the plan for starters. It should only be when you really want to take this on and you're cognizant of how long it is going to take. And look, I wasn't as well. I wasn't until I started to get into it, and I didn't have any mentors. When I first started, I didn't know any. But once I realized that I wanted to be, that this was serious and I wanted to take this serious, that's when I started to put together my business plan and my trading plans and other journals and resources. But that wasn't until probably 4 years, 5 years into it, after trading part-time for 3 years. But I did have, in that early part-time, I did have a trading plan. I did have a checklist, so I did have some things, but I wasn't trading with sort of the money that I was trading with, smaller accounts. I was still decent accounts, but not as much as when I went full-time.
Yeah. Do you have another 15 minutes maybe?
I do.
Regarding P&L, in a regular business, you would have like kind of your sales target or, revenues target, and you may even forecast that out 5-10 years down the road. If we were to treat trading as a business, how does P&L targets fall into this? Because because I ask this because how when traders are learning to trade, the focus should be on the process and on, building good habits, self-discipline and things like that. But if you're to treat trading as a business, where does P&L fall into this?
Having monetary goals, P&L goals early, I think is set you up for unnecessary pressure. The focus should be on good process. The focus should be on doing our job properly. So if we think of it this way too, money is a byproduct of me doing my job properly. That can help to reframe it away from money. Having that focus on money is not going to be good early on. The only time that I would start to put P&L goals in place would be once there's a level of consistency where we can fall back on our statistics, and we know for the last 3 years we've done 65% win rate, a payoff ratio of 1.8 to 1 and a profit factor of 2.5. We've got our statistics we can fall back on. Then it's only a matter of just ramping up the risk, but ramping up the risk gradually. But I think to do that too early until we've proven it puts unnecessary pressure on you. Within the first year, when a student goes live, the focus should be on basically breaking even. If you've broken even in your first year trading full time, you've done well. So the focus must be on doing your job properly. The focus must be on following your processes, following everything that's laid out in your trading plan, everything that's laid out for the business, following your daily routines. When you're doing that properly and thoroughly and disciplined, then you've got your methodology down pat, and you are performing your job properly. Only then really should you even be thinking about it. And when you do go live as well, now is the time when you'll start learning about your psychology, because now you're going to get those emotional triggers from having something on the line. So I always recommend that you go live with a small amount, risk a small amount, to allow yourself to now get used to trading live, but to experience those emotional triggers that are going to happen because you've got money on the line. And trust me, they're going to now occur, you'll be aware of these early on, but then they'll be amplified when you do have money on the line. So what the last thing we want to do is to have these emotional responses so large from having big accounts that it's putting us, to use, to steal a saying from Mike Bellafury, it's putting us on tilt and we can't function. If you come out of the week and you've lost $30, $50, that's manageable. If you've come out of the week and you've lost $2,000 to $3,000, that's difficult. Losing $2,000 to $3,000 when you're making $5,000 to $10,000 the next week is fine, but you haven't worked up to that point. Give yourself the right to trade bigger. And how does that come? From being consistent with smaller money. Now, a lot of people say to me, well, look, I can't trade with, risking $30, $20, $30 a trade. My response to that is, if you can't make $50 a week, you're not going to make $500. You're not going to make $5,000.
Good point.
So start small, allow yourself to experience the emotional responses that are going to come, and start to work through those. And when you've got those under control and your equity curve should be now reflecting that, then only then should you be considering to gradually and incrementally increase risk. And then really you'll reach a tolerance where this is it, this is what I know, this is fine, I'm happy with this, but always be pushing the envelope in terms of risk. I've said it many times, follow the process and the money will follow.
Good advice. And do you think that there are traders that have been successful without treating trading as a business? And I personally think that they do treat it like a business to some degree, but maybe they just don't call it as that. But maybe there are some outliers. What are your thoughts on that?
Oh, look, absolutely. There's always going to be those. There's always going to be the outliers. However, you've hit the nail on the head in terms of there's going to be some degree of, this is a serious business. Otherwise, really, you are just almost have that gambler's mindset. They will be treating it to some degree in a business fashion, whether they've got a documented process or not. It will still be in the back of their mind in thinking like a business. It's got to be. Some people might be able to not wing it. That's probably not the right word. Some people may just have a bit of a gift to be able to do that. Some people may have money scripts that are lend themselves to be able to, put serious risk on without having amplified responses, to having money. And some people might have the opposite, where money is actually going to trip them up because of their monetary scripts. So I would recommend people have a look at that as well. Just analyze your thinking around money.
Another thing is when people hear treating trading as a business, they may ask, does this mean, like setting up your trading business like as a LLC or LTD, and thinking about tax implications? Obviously, every region, every country is different, but that should be something that's part of your trading business plan as well, I suppose?
I think yes. I mean, you don't need to go to the extent of setting it up as a full-blown sort of business. And I think initially you don't want to be adding additional moving parts, such as having to do extensive business reporting, etc., for the tax man. I don't think that's advisable first, and you don't need to operate under a big structure. I don't need to. My accountant has advised me accordingly, but I can still get some of the perks and things that I need to legitimately without going that full extent. So I think if you are serious about, if trading is your full-time income, well, yes, there's going to be certain things that you need to follow, but you don't need that level of detail, I don't believe. If you're employing others to trade with you and that sort of thing, maybe, but I would say keep it simple initially. Don't unless there's huge tax advantages, I wouldn't suggest, adding sort of too much detail. And look, each country is going to be different in terms of their tax rules. So I think I think at least you need to be aware of that and how trading can, what benefits there may be. I think if you're aware of that, that will help. Or simply ask your accountant, I'm trading seriously. I'm considering it as a serious part-time business. What can I claim?
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
You covered a lot here, and I've learned a lot, and there are a lot of questions to ask ourselves. And, I guess the biggest general takeaway that I got from this is by having a business perspective on trading, it shifts your mindset in a different way. It just does. It shifts your mindset to think about trading differently. I wanted to ask, as we ask many of our guests on the show, what are your struggles, if you have any, that you're still working on in your current trading?
Absolutely. So my current trading now to where it's at, and I should have touched on this earlier on, but I trade our Aussie stock market here. I'm in Australia, so I swing trade our Aussie stock market, when it's going the way that I need it. So I have market filters around that to swing trade. But I also intraday trade our Australian stock market, usually only up until lunchtime. And then I want to do things in the afternoon, go to the gym, do other things. And I find that's when most of the liquidity is here. Unlike the US stock market that I've traded, I absolutely love that. The time slot doesn't suit me. It's too late. But so I intraday trade our Aussie stock market. What those two do give me, the swing trading gives a bit longer term sort of income generation. The intraday trading or scalping, that's able to bring in, monthly income, that sort of thing. So I love that. But because I'm not naturally wired for the smaller style, that took me probably 5 to 6 years to get consistent at that. The intraday or the scalping, and I also swing trade and scalp the FX, commodities and indexes, time permitting. You can't do all of that at once. I still, trading for me is a lifestyle as well. So I don't want to be doing, 10, 12 hours a day. So I've limited my time. So that's the style that I do. So look, some of the current struggles that I have, probably maybe slightly impatient, but I'm catching myself. So more. A lot of them will stem from personality traits, and one of probably the biggest, which I know and I've heard a lot of others say, probably letting the trade run. As much as we come up with our plans and things, especially when you're shorter term trading, because those emotional responses are so quick, it's catching myself when the trade is going against me to be objective in what it's actually doing. Now, we're talking 1 minute, 2 minute charts, so it's very fast and it's very quick. It's catching myself to when I'm being triggered and then overlaying and applying that thinking script to collapse that initial thought. And that usually, probably the worst is probably, is letting the trade run. Does that maybe come from, back in the original times, we're trying to get trading, having no other income, trading was sort of scared money, probably, but I'm certainly getting, a whole lot better with that. A lot of experienced traders and others that I speak to on a regular basis. That's one of the most common things, letting the trade run. But look, at the end of the day, when I look back and you do your reviews, for the majority of the time, getting as much out of the trade as to what's on offer. I'm thankful the times that I have actually cut where it was, and that first thought was right. But probably more just stopping and catching myself from starting to cut the trade when it looks like it's maybe run. So that's one, and I think that's common. Also, letting too much of the trade go too early. Look, that's kind of fear-based. I know where that's come from, and I think that's sort of common as well. And there's ways around that as well. It's always better and easier when you've got a couple of wins under your belt early. When we've got a couple of good trades, we tend to be, the master of trade management. Whereas when we haven't, we tend to want to bank that. So we've got something in the bank. And that is a whole different thing. I think being aware of it. But look, I think a lot of that comes from, I want to have lunch and I want to go to the gym and I don't want to be in this trade anymore. I think that's where it comes from as well. A lot of it, I'm aware of that. I don't want to be managing, babysitting this thing. If it's done its move and the momentum kind of looks like it's done, I don't want to sit there and micromanage it. I'm done. I'm out. Do I come back in the afternoon? I've left, quite a bit on the table. Yes. But that's a function of me trading the hours and the times that I want. If I want to just trade for 2 hours in the morning, I need to just catch that momentum, move and be done and be satisfied with that. But there is always that I could have done slightly better. But you learn to deal with that. You learn to accept what you've had. And a lot of that comes from being critical of yourself as well, as we spoke about before. Your performance is always, you try and be better and better and better. But a lot of times you just need to accept that, hey, you know what, this is pretty good. This I've done reasonably well. I need to be happy. And yes, you always need to be trying to better yourself. You always need to be in the back of your mind, have your average win there so you can better that all the time without putting unnecessary pressure. So that's just part of, performance, isn't it? You're always trying to better yourself, always trying to better your average. But that's all just part of it. So that would be probably the worst one. Trying to milk as much out of the trade as you can with the time that I've got.
So I imagine that your trade life balance must be pretty good, because you mentioned you go to the gym and you don't want to sit at the screen for hours. I mean, what's your trade life balance like these days?
So it's taken me a while to work to it, and it's taken me a while to put all my tasks into the right routine so that they fit within that. But typically, yes, morning and up until 12:30 sort of PM, our time here, 12:31. That's kind of when I can function sort of better. I find that I've got the most focus. I find that I'm keen. I'm a bit more fired up, I suppose, to be able to do it. And then I like to. And I mean, look, when you're scalping, reasonably intensely too, you can't do it for long periods of time. You need those breaks. So for me, having that big break is good. If there's any trades that I do have open and I've removed 75%, and I think this is a good entry, then that I might hang on to that as a swing trade, but I would journal it separately, just has a better entry. Those I'll monitor at the end of the day, which is about 3:45. So I'll make sure I'm back here at 3:45 PM for our market close. And then, kind of after dinner, and sort of from then on, I'm free to do sort of what I need. I do a little bit of work. I do my journals, but I journal throughout the morning as well. Review that, set it up for the next day. Do some scans for the next day in terms of swings. But look, I've worked it into a lifestyle. And that was one of my goals, was a lifestyle goal. And, I've been able to work it into that. I like to do other things with my time as well. So it has sort of worked into what I want, my overall plan, but it's taken time to get there. But keeping that plan in mind is important. And I love to share what I do. I love to teach and train. I've mentored for about 8 years as well, so I love to do that. But I only take a sort of a handful at a time. It's not, but I'll do that in the afternoon as well. If I don't go to the gym, if it's my day off, I'll do that. 2 p.m., 3 p.m. my time. So I've worked it in with what I want, but it's taken time to get to that. But I love what I do. I did enjoy my previous job and did enjoy the challenge, but I absolutely love what I do now. And I think that's part of it as well. You need to have a passion for what you do, otherwise you'll just lose interest. Or if it's monetary goals, you want to buy the next Mercedes. If you don't get it in 6 months, you'll just fall away. So you need to have valid reasons for doing what you're doing, not just financial reasons.
Yeah. Now, if you knew 16 years ago, 15, 16 years ago, how much work it takes, how much the roller coaster of trading is, would you do it again, honestly?
Look, I would. If I had known now if I had known then what I know now, I would have probably done it slightly differently. Look, a lot of the mistakes I made early on actually were good to get those out of the way early on. And it's the old saying, when you can make those mistakes early on, and especially, having that early success and then, getting the global financial crisis early on and get that out of the way, it now makes you more aware of that in the future and protect yourself from that. Whereas if you've been trading for 10 years successfully and then you hit something like that, unless you're prepared, it's going to, there's a chance that it could blindside you, especially if you're a swing trader and you don't know how to sort of cut out and have a market filter. But yes, look, I probably would have done it differently. I would have had a mentor. I could have maybe cut the time to get consistent down, absolutely. But I didn't know any back then. I didn't know any. I knew the importance, absolutely. I spent money on formal education, and that that has served me well. But I think also too, being more aware early on of my psychology would have helped me to be more aware of it as it was occurring, and having a plan in place when it did occur would have helped me get through those and master my psychology earlier. That's probably the biggest thing.
But it's hard to master your psychology earlier, especially in an earlier stage in your trading, because that doesn't come until later. You don't realize those things until you go through the roller coasters, because in the beginning you are just learning to trade, right? You haven't had to deal with psychology yet until you start losing a lot of money and getting whipsawed.
True. The thing that I would say too, and it does work, is when you start to know about it, when you've studied it, and often people have said, and you hear this from the market wizards and that, they should have been learning about psychology first. No, it won't make as much, it won't have as much impact, or it won't make sense at the time. But when it starts to occur, now you can fall back on, that's what it meant when I read that. That's what it meant. So when that occurs to you, you now know what to do. You're not blindsided by that emotion. You've got a plan in place, and this is what I teach as well. When we've got these routines down, Pat, they're to protect us when we do have these responses. So when it occurs, we now know what to do. It's a matter of just following through and knowing then how to do it. No, it won't make sense at the time, but when it occurs, it's in the back of your mind, this is what we were talking about. Okay, I now know how to deal with it. You're absolutely right, though. You won't know the importance of it until it occurs. But knowing early on, and trust me, even early on, even in back testing phases, you'll get a bit of an inkling and you'll get a bit of a snapshot as to what is affecting you. And there's only a couple of root causes, but they manifest themselves in different ways.
Yes, absolutely. Thanks, Mark, for coming onto the show and helping us to see trading from a business perspective, something I feel that is very much underrated. And I really believe that today you help to break that topic down a lot more for us to actually understand more of what that means. So for those who want to reach out to you, what's the best way for them to get a hold of you?
Thanks, Jess. Yes, look, it's been great. It's always good to I guess learn from others' mistakes, and I mean that's always my hope that if you can take one thing away from this, then I think it's been worthwhile. So no, it's been great. And look, too, there is a to get in contact with me. There is a I've done a workshop on treating trading as a business. You can find that, and you can contact me at the Chat with Traders community. So you can find the workshops on there, and you can also contact me through there. I don't have a big presence. I don't use Twitter. I don't use a lot of social media. I tend to just be a little bit sort of more private. But I do have a website for mentoring, and that is www.integritytrading, or one word, so integritytrading.com.au. That gives you a bit of an outline as to some of the mentoring that I do. I enjoy that side of it. And the email address for that site is info@integritytrading.com.au. So they're probably the best two ways. But a couple of other workshops I've done at Chat with Traders community there as well. For those that are a little bit newer, a good one is the Traders Roadmap to Success. It outlines their steps, so I recommend that you go and check that out. But yep, as I said before, there is the whole trading business plan in detail, so workshop there as well. So that's a bit more detail on today's discussion. So thank you, Tessa. It's been great.
Yeah, thank you for coming on to the show. Thanks for your time, and we will stay connected.
Sounds good. Appreciate it.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
as full-time traders, a lot of people think, well, you just don't feel FOMO anymore. And it's not that I completely erase these emotions from, my body and brain. It's that I'm able to recognize, I'm able to say, I just had this thought, and this thought tells me that I'm feeling FOMO. And so I'm not going to act on this trade because I know that acting on FOMO is not a good thing. And this is one of the aspects where becoming a better trader, if you're really in this, it makes you a better person, in my opinion.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey there, traders. I'm Tessa, co-host of Chat with Traders. We're in episode 267. Today, Ian interviews Dan McDermott. After stinging losses with mutual funds in 2008, Dan was driven to become an active manager of his portfolio. Enticed by the legalization prospects of marijuana, he dived into learning the fundamentals and technicals of this sector. Learning how these stocks traded relative to each other, he cultivated an awareness of the correlations between these companies. These interrelationships would later be applied to large cap stocks, commodities, and crypto across different time frames to give insights on when to participate in bull and bear runs and when to back away. Feeling the pain of big early profits evaporating over months, Dan was forced to cultivate a mental flexibility in trading by considering both bull and bear signs in every stock he follows. Learn how he combines correlations over multiple time frames with other stocks in the same sector, influences from commodities, the dollar, and various sectors, and is able to flush out nuances with scalpel-like precision and ready to flip bullish or bearish without attachment. Ladies and gentlemen, we're so pleased to present Dan McDermott of the Chart Guys.
Well, Dan, welcome to Chat with Traders.
Thanks for having me, Ian. Glad to be here.
Yeah, let's dive into your background a little bit. Where did you grow up and where are you now?
Sure. I grew up in Massachusetts, about a half hour north of Boston in Andover. And after going to college on the coast of North Carolina at UNC Wilmington, stuck around and currently in Western North Carolina, loving the mountains and the warmer weather.
Nice. What were your career desires in school?
So I started as a business manager. I finished as a business management major, and that was very, vague in the sense that I could apply that to anything, whether I wanted to run a farm or, whatever it was going to be. They had some basic classes like leadership and entrepreneurship and things like that. And that definitely got me in the business type of mindset, but there wasn't anything directly related to the stock market in my studies. And so that was really an area that was lacking. And so it required a significant amount of self-directed study to learn about the inner workings of the stock market.
Was there a particular catalyst to get you interested in following the market?
I would say losing some money. So what it was is, in high school, I had my jobs of, I was mowing lawns and I was a lobsterman up in Cape Cod, and I saved up $5,000. And so then I go into college, and my dad is very, standard, work a 9 to 5 in a corporate job for 30, 40 years, put your money in the market, and then you retire. And that's gone very well for him. He's now retired and traveling around. And I looked at that, and essentially I started to think, I don't want to do that. I don't want the 9 to 5, sit in traffic, driving into the city kind of job. And so I had that $5,000 and I put it in mutual funds as I headed into college. And I wasn't paying attention to markets at all. I was concerned with going to college and all the things that entails. And I then, that was right into 2008. And so I start looking, and my $5,000 is now $3,000. And it's like, wait a second. If I'm going to lose money, I want to be the one to lose it. I want to actively be losing it. I don't want to put my money in a mutual fund and have it go down like this. So I didn't fully understand what was going on in the markets during 2008. But the catalyst of losing money and not wanting a 9 to 5 was enough for me to start poking around at alternative ways that I could, I knew the internet had a ton of opportunities. How can I make money on the internet is essentially the mindset that I was in.
Did you have any friends or family in the markets by chance?
Not actively, just my dad, the standard mutual funds, safe long-term investments. But other than that, not really much exposure.
Yeah, I'd like to dive into your early trading. Apparently, the first stock that you bought was a medical marijuana stock. Was your interest in marijuana sector a catalyst to get you into that stock? Or, I mean, that stock's also a penny stock too, right?
Yeah, I mean, it was the catalyst to get me into markets. I looked, I'm looking around. How can I make money? How can I get out of the 9 to 5 grind? And I could see clearly the trends that were shifting in social sentiment around the country regarding cannabis. And, 2010, we had a vote in California, the first attempt to legalize, and it actually failed. But I could say, okay, the ball's rolling. I can see the way things are going. I was reading about CBD in books before anybody knew what that was. And I said, okay, there's something to this. There's opportunities here as the laws continue to change. And so I really reached a fork in the road where it was, I'm either going to go to Canada, which had a decade head start legalizing industrial hemp. I'm either going to go to Canada and learn how to grow this plant in the fields and take the farmer's route to be ready to hit the ground running when the laws change here. Or there's these stocks, there's these penny stocks out there. And, back then that was really all there were, just a handful, maybe 6 penny stocks. If you, used Google to look for opportunities in cannabis, they just didn't exist. So that led me down to MJNA, which was the first stock, and then just fell in love with the game. And at that point, I was fundamental based in the sense that that was the reason I was interested in the sector, and I started to I was almost like an investigative reporter. I was reading about the CEOs and their past experiences, and just started to be a significant sponge for knowledge in terms of, all right, I've got my, way of this is how I can make money using the internet. And now I want to try and figure out what I'm doing to a certain degree, because obviously when I started, I had no idea what I was doing.
Were you influenced at all by any of the penny stock pumpers or chat rooms, or did they not cover marijuana stocks?
Oh, they certainly did. I was in there on Investors Hub. That was the big one back then. And that honestly helped change my life for the better, in the sense that, I'm looking around and the first thing I ever learned about the market was, all right, these penny stocks put out a press release. They pump very, temporarily, and then they fade back. And so I thought, if you sell when news comes out, you can rebuy lower. And so the first thing I ever learned was sell the news. And then, from there, I'm looking around in the chat rooms, and you've got your cheerleaders, the people that, fall in love with the company, and this is going to be the one, and just, highlighting everything great about the company. And then I started looking around and found a couple individuals who were using technical analysis and charts, and they were right way more often than anybody else. And so, I zoomed in a little bit and said, all right, I need to focus on what these guys are doing. I need to learn from them. And that's what started the shift from fundamental analysis to then going into technical analysis. And I would say at this point, bought my first penny stock 2010, lucked out a bit in terms of, short little bull markets that kept me making some money, not knowing what I was doing. And then maybe around 2012 is when I started to really get serious into the technical analysis aspect.
So for the first few years, early on, you were trading based on the fundamental prospects, and then later you saw that these traders were doing quite well with just technical analysis. Did you expand out beyond the marijuana sector once you looked at, hey, technical analysis? I mean, this could apply to anything, and marijuana is just one of many stocks. Did you expand out into other penny stocks or other regular stocks?
I did. And it definitely, it was almost like the getting more familiar with charts and technical analysis made me more comfortable stepping into realms that I didn't have any fundamental knowledge whatsoever. And so, there were e-cig companies that would have a little bit of momentum behind them, and really anything. Back then there were even some Bitcoin stocks in the early days. And so that did, pretty much anything where there was some momentum and some volume, and the chat room started talking about it. And that actually helped me, learn the social aspect of the game, where, I could look at how many posts a stock message board had over the weekend and get a good sense of, this is going to continue running when the week starts next Monday, or, there's not a lot of interest here and things like that. So that really connected the puzzle of the technical aspect and I guess that would be the early days of social media, these forums.
Did you have any early mentors, or did you just have people that you followed on the message boards?
There was one individual. It was, the person that I came across on the message boards. His name was Osprey Eye, and he was just a very generous individual, just in terms of willing to answer all my questions. And so, he's looking at RSI, he's looking at Bollinger Bands and volume, and he would type out, his paragraph of technical analysis for a chart, and I would just follow along and read it. And eventually, I just started to emulate exactly what he was doing. Like, all right, if he's looking at this chart, what would he be pointing out? And I was typing down, even to his style, he would put, multiple dots instead of a period. And I even started typing that way, as I was just trying to do what this individual does, because they were doing it a better job than anybody else that I had come across.
Were you able to hold yourself accountable in any way? How was early trading for you?
Definitely had, I made every single mistake. I learned all the lessons. Like I said, I lucked out and got a bit of a cushion where I didn't know what I was doing, but stumbled into a bull market for these cannabis stocks. But, I swung trade. I bought a Chinese name that I was planning on holding for 2 or 3 days, and it delisted overnight. And I just lost, maybe 15% of my entire net worth. And so, that's a huge hit to my gut and a lesson learned. And then later on, maybe a year or a couple of years into technical analysis, I was still doing a bit of the fundamental side, and there was a rare earth mineral company. And, I thought I found the next big one. And really the most dangerous aspect was the price was affirming what I thought I knew fundamentally, in the sense that, the stars aligned for this name to run, and it ran maybe 600-700%. I turned $7,000 into, 40 something $1,000. Fresh out of college, early 20s. And that was a lot of money to me back then. And it was almost like the price action affirmed, yep, I'm right. This is going to be a big deal. This is one to hold long term. And of course, I gave it all back. I gave back all that profit. And honestly, that lesson of seeing all of those gains, which were fairly life-changing at that point, just in, a zoomed in sense, giving it all back. And because I had that lesson so early on, I'm extremely grateful, because then when, the crypto boom happens and all these other euphoria markets, I know to lock in the profit along the way. And I know that these big pumps lead to big drawdowns. And so that was one of the major takeaway lessons from the penny stock world that helped shape me for success as a trader further down the line.
Mm-hmm. So did you find yourself rationalizing to yourself, this company, this rare earth company will come back. It's got good fundamentals. It's got this, it's got that. Did you reflect back on all the excuses your mind created for why this rare earth company is worth holding on to?
Oh, absolutely. I mean, you go through everything. It's the shorts, the manipulation, and I was rationalizing. And it was even to the point of, again, just thinking that the shorts are going to have to cover. And another major lesson that it led to was starting to realize, all right, this is what dilution is. This is what convertible debt is. And I didn't know what these things were, for my first 4 years in the market. And of course, when you're in penny stocks, that is penny stock 101, is these companies just dilute to, pay the insiders and to stay actual companies, whatever operations they may or may not have. And then I learned the lesson, the vast majority of these penny stocks are scams. And so that was when it was time to upgrade to real stocks that were listed on real exchanges.
When did you switch over to, quote, real stocks on the exchanges? And what was the catalyst to switch?
Oh, I would say maybe around 2013, 2014. And it wasn't, cold turkey quitting penny stocks, because I was still keeping an eye, if we get a run up into the election season when some individual states like Colorado or Washington are voting on legalization, these cannabis penny stocks would still get their, runs, and there was still opportunity there. But I would go to, Twitter back then was a name I was watching, and then the 3D printing sector. And I didn't, 3D printing, DDD and SSYS, some of these names, back then, I forget if it was 2013, 2014, they ran, 1,000% or whatever it was. And that was just, that version of new technology, get in early. This is going to change things. And I didn't make a lot of money in that pump, but it was just another affirmation of all right, this 1,000% pump led to a 95% plus pullback. And, I would say at this point in my trading career, I'm a bit of a hype specialist. And because I've seen these penny stock pump and dumps and, the 3D printing pump and dump, you have to observe these things and watch them play out to gain the experience so that the next time it comes around, you're able to capitalize on that opportunity.
You mentioned about being in a Chinese stock that got delisted overnight. Did that experience push you into just day trading out of fear of holding positions overnight, or did you still hold on to swing positions over days and weeks?
Definitely, that was a factor in the switch, and also capital. The more I get capital, I can remember getting the call from Fidelity. Hey, you're under the 25,000 limit, and you gotta. You're putting time out for whatever good faith violation. But that was, that Chinese penny stock lesson, not only for swing trading, but also I was very surprised at how quickly I recovered from the big gut punch. 15, 20% of my net worth is now gone overnight. And, it took reflecting. I can remember going and sitting out on the beach the next day. And about 24 hours later, it was like, all right, I got through it emotionally. It wasn't hindering me significantly. And that was a major point for me the next day or two after that, where I had the realization like, okay, if I can stomach this and push through this, I can do this longer term. And so it was almost like a motivator. A lot of people perhaps would have let that be a demotivator and, wallowed in that misery. But for me, it was a positive catalyst.
When you switched to mostly exchange listed stocks, did any of your strategies change?
Yeah, definitely. As I continued, I used to watch level 2 with penny stocks, where a little bit of, dollar volume, $100,000 or whatever number, could significantly influence things. And then you get to watching Apple, and you watch the level 2 of Apple, and it is just flying around. And it became a lot less useful for me using level 2, and I started to focus more on the moving averages and things like that. And again, the biggest change for me was as I started to build up capital a little bit, my trading style started to shift, where it was, okay, I don't have to hold for weeks or months to get a monetary win that was worthwhile. It can be done in just a day.
So these stocks typically move less than the penny stocks. How did your strategies get refined to extract out profits during the day?
Yeah, I was very moving average heavy. It was the Bollinger Bands. If we get extended under the Bollinger Bands, it's time to keep an eye out for a bounce, or vice versa if we're extended above them. And I had 10-day moving average, the middle Bollinger Band, 20 period, the 50, the 100, the 200, and all these different colored lines on my charts. And that was part of the backbone. I wasn't really, later in my career, I transitioned to just pure price action trends, where you pivot off a level, and that's now a high or low support to be paying attention to. But when I had initially transitioned to, we'll call them real stocks, that's when I was using a lot of those moving averages. And, I wasn't doing too well. I wasn't doing anything special. I was learning the game. And what I say to a lot of people is, if in your first year you go break even, you just got an entire year of free education. And so when I moved up to the big boards, it was definitely a drastic change of the way that I was playing the game. And, a lot of small green months, small red months, and just being patient with myself, knowing that it was building education and experience that would pay off later in life.
In one of your videos, you say to don't zoom in because it can lead to over trading. What time frame is considered zooming in, and would it vary with trader experience?
Yes, definitely. That varies for every individual. I'm looking at, sometimes I'll look at the 1 minute time frame now, and anybody in their first, year or two or even 3 of trading, I would say stay far away from the 1-2 minute time frames. You definitely need the experience because things, technical analysis, the beauty of it is that it's the same on all different time frames. The monthly chart and trends and things like that apply the same way that the 1 minute chart does, but obviously it's just way faster. You've got way more pressure in terms of, when you have to act and how much time you have to analyze things and think on things. So if you are newer to trading, I definitely suggest starting with swing trade mindset. So you do have the time and the lack of, pressure to be able to think, essentially, because that's a muscle, that you've got to train. Your brain is we'll call it a muscle in terms of, needing to be able to analyze things more quickly. And obviously you have to do that with repetition and a lot of practice.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital. Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So let's dive into how you look at the different time frames and their relationships. Do some time frames have more importance for you, or is it the relationship between them that counts?
It's the relationship. So if I'm focused on a swing trade, then I care most about, the weekly and the daily time frame, and I will zoom into the hourly chart to try and pinpoint entries a little bit. If I'm day trading, I care about maybe the daily, the hourly, and the 5-minute time frame. And the one thing about the time frames and the relationships that they have with each other is let's just use the 5-minute and the hourly, for example. A 5-minute, let's just say we're in an hourly uptrend, a clear higher lows and higher highs of price action. If you're seeing hourly consolidation and you're looking for an hourly higher low to try and form to maintain the hourly uptrend, if you zoom into the 5-minute time frame, it is often the 5-minute trend going from a downtrend. It's in a downtrend during the hourly consolidation. And then when you change the 5-minute trend back to the bulls with a little higher low and higher high of price action, that will very often mark the hourly higher low. And so these timeframes have these relationships. I generally use, the 5-minute with the hourly in stocks. If I'm trading crypto or futures or something that has more hours in the trading day, I'll use the 15-minute with the 4-hour chart. I use the daily chart with the weekly chart. And it's almost like riding a bike in terms of it takes a long time to understand this concept of how these time frames are all essentially, these little fractals within each other. But once it clicks, it's like riding a bike in the sense that, it makes a whole lot more sense. I know that, once the first hour of the trading morning plays out and I see, something shaping up, I know to zoom out to the 15-minute time frame and keep an eye out for, if we dropped on the morning, zoom out to the 15-minute and look for the 15-minute lower high to be the result of the next bounce. And you start to get really comfortable with how these different timeframes interact with each other.
Mm-hmm. So do you select different timeframes depending on what you're trading, like whether it's a a penny stock, a listed stock, crypto, commodities, what have you? Or does it do you use the same time frames because they're transferable no matter what you're trading?
I'll use mostly the same time frames, but it depends on the setup. And we'll use gold as an example. So gold is a lot less volatile than, say, Tesla. And so if I'm looking at gold, I know that I want to be looking from a swing perspective. So it's the daily and the weekly that I care most about. And if I'm looking at Tesla, well, Tesla can go 5 to 7% in a day in either direction. And so then I'm a lot more focused on maybe the hourly and the 5-minute time frame. So it definitely has to do with the volatility of the instrument that I'm looking at, as well as the time frame that I'm most interested. If I see a clear setup on the weekly time frame, then I'm going to ensure that I'm not too zoomed in, because the 5-minute time frame means nothing to me if the weekly time frame is the basis of the trade setup that I'm trying to make an entry on.
Mm-hmm. I'd like to jump into talk about crypto a little bit. And my understanding is you got into crypto in 2017?
Yeah, May of 2017. And it definitely, changed my life in many ways, not only the financial gains, but also my trading style. That was probably the most pivotal, drastic shift where, I was watching the main reasons that I got into crypto were number one, we're approaching blue sky breakout all-time highs. And I know from my previous experience, that's when price discovery happens. That's when there's the most opportunity for hype and euphoria and gains. And then, I'd get the article of the banks are looking at Ethereum for the potential and saying, okay, well, we've got the combination of potential, future technology that people want to get in early on and all-time highs. And so that is what got me interested. And, I got to give a big shout out to one of my friends I was living with. He's an entrepreneur as well. And, I dipped my toes in with maybe 8% of my trading capital. I put onto Coinbase and was like, all right, I'm getting into Ethereum. And I told my buddy this in the kitchen. And the next day he wakes up, comes into the kitchen and he says, I'm all in Ethereum. And that's just, his style of really aggressive all or nothing. And so I reflected on that, like, all right, I guess this is an opportunity where, what do I have to lose? I'm going to go real aggressive here. And one of the fallbacks for me was always worst case scenario. If I lose this money, I just get a 9-to-5. And, I'm confident in having skill sets that would be, able to get me a 9-to-5 job to fall back on. This is the route that my dad did. And I can do that as a worst case scenario. And just one thing to touch on to zoom out a little bit is I have to acknowledge the fact that my dad paid for my college. And that was, a lot of people have this concept of, are you self-made millionaires and things like that. Well, I've made every dollar that I have, but I had the stage set. Because he paid for my school, I was able to take on risk and able to explore being a trader and, risking my money in the online world. And if I was leaving college with 5 figures of debt, there's no chance I'd be playing with penny stocks and risking the little money that I had saved up through high school. So that is definitely, psychologically had a major impact on my ability to go more aggressive and keep that, worst case scenario, I'll still be fine mindset.
Yeah, that was very generous of your father to pay for your education there. Prior to getting into crypto, did you participate in any other sector bubbles? And were you partially influenced to get into crypto because you felt you missed out on the 3D printing bull run?
It was as I mentioned, seeing the cannabis pump and dump, seeing the 3D printing pump and dump. It was a factor. It was, again, just knowing that when something new hits the markets, whether it's changing laws of cannabis or new technology of 3D printing, that's when there is the significant opportunity and things get a bit crazy. And so it was, it wasn't FOMO in the sense of like, I can't miss this opportunity. It was more like, I've seen this setup before. I've seen this happen. And now that I've witnessed it a few times, and while I didn't capitalize back then, this is the time that I'm looking to capitalize. And in hindsight, after 2017 went so well into 2018, it was almost reflecting back on my trading career and being like, man, the 5 years leading up, or I guess at that point it was closer to 7. The 7 years of my trading career, it was literally all just preparing me for this one moment in terms of, if I tell anybody that wants to be a trader, this is how much money I made in my first 7 years, everybody would say, no, thanks, not for me, not worth it. And then it's just that one moment that, all those hours, all that preparation, just everything aligned to capitalize on that opportunity. And that was the pivotal change for me. Again, not only in capital, but shifting my trading style.
I see. So how did your trading style shift by getting into crypto? Like, what did you do new and differently that you hadn't done in the past?
So I started simplifying my charts. I removed all the moving averages. At that point in time on Coinbase, they had a default chart that was on their homepage, and it had EMA 12 and 26 on it. So I was almost forced to look at it. And I just noticed like, that comes into play a lot. The price is, respecting EMA 12 a lot. And so I ditched all my simple moving averages. I took EMA 12 and 26 and started using it. And again, it was just all price levels at that point for pivots. And one of the main ways that I was able to capitalize on the euphoria was I was still actively trading. It wasn't just a buy and hold for me. Because of that, the amount of volatility, I mean, you'd shoot up 150% and you drop down 35%. And I started to recognize patterns in what I call them now back burners, but it's when you're in a breakout market. First 5-minute oversold conditions very often marks your hourly high or low, going back to the time frame relationship, and then you get continuation to a new all-time high. So it was getting really good at buying the dips essentially based on using RSI and time frame trends to pinpoint those entries. And it even got to the point where it was so consistent that my entrepreneur buddy who didn't know markets at all as far as a technical analysis perspective, I just told him, like, if you're going to trade, just when this little line goes under 30 on the RSI, that's when you buy. And it just worked consistently until the top was hit. And fortunately, at that point, I knew, I sold before the top. And of course, when you do that, you're going to get everybody telling you you're wrong and buy and hold is the way to go. And you're an idiot for selling early. But it's the kind of thing where it's like, I'm content with my gains. And, if I come across money that can change my life, I'm going to lock that in. If it keeps running, that's great. There's ways that we can shift our perspective to have, to view the same situation positively or negatively. And just a little example for that, one of the things that I also did in crypto started to do was scale into and out of positions where previously, with my account size, it was I'm either in the trade or I'm out of the trade. And so then I learned, all right, you can break things up a little bit. And so just an example of mindset, if I'm selling into a bull run and I sell half and it keeps going up, I can psychologically say, great, I'm still making money. My net worth is still going up. I've still got half a position. And if I sell half and it drops, I can say, great, I locked half in. I've got capital to buy the dip if I want. And the exact same situation, psychologically, I could say, I sell half, it keeps going up. Oh, I'm an idiot. I should have kept the whole position. I could have had this much money. Or if, I sell half and it drops, oh, I'm an idiot. I could have sold everything and had this much money. And that is literally up to the individual. You are in control of that thought process. And so it's so important to stay on the positive side of things because it's very easy to get into a negative spiral and get down on yourself. And that definitely has an impact on your trading as well.
I see. So scaling in and scaling out, is that a way to kind of protect yourself psychologically so that you don't feel so bad getting all out and then it rockets up higher and that you feel that you're still participating?
Yeah. And it's also, the egotistical realization is I'm not going to nail tops and bottoms. I should not have any expectation to nail tops and bottoms. That's going to be rare. And so if I'm scaling in and scaling out, I can get closer to getting those tops and bottoms. And just being, more gentle with myself, essentially, where psychologically it was not as high stakes to make one decision and then have, your short-term future ride on that one decision.
I see. So was there a point that you said you got out of crypto almost completely, like you almost entirely sold out?
I got to a point where, I established some long-term no-touch positions is what I call them, where, I account for them as zero when I'm figuring out my personal financial situation. And I'm either going to hold it for decades, like I got friends, grandparents who have double-digit millions of dollars, and they've been holding the same stock positions for decades. And so, all right, if that works in crypto, I want to have a piece for that possibility. So I set that aside. It's not for trading. I literally don't touch it. And then, everything else, which is the vast majority, I was exiting at that point. That was the run where we topped out at 19,000, but I was selling 16, 17,000 on the way up. And, once we did top out, we very quickly returned back down into those mid to lower teens. So I was essentially all out of my trading positions and all cash by the time Bitcoin had topped out.
Did you jump back in the 2020, 2021 bull market?
I did, and I was late. And that's one thing that I tell newer traders is, again, you don't have to nail the bottoms. That was, let's see, we flushed down to 3,000 during, max fear. And I don't think I re-entered until I had a technical setup that I was comfortable with. It's what I call an equilibrium, which is just a tightening range of higher lows and lower highs, constricting price action, constricting volume. They generally lead to a break and then a spike in volume and volatility, one direction or the other. And so I saw that shaping up. And at that point, we were trading, around 11,000. So I missed from 3,000 to 11,000, multiple 100% off the lows, but saw the technical setup that I'm comfortable with and familiar with. I said, all right, that's good enough for me to establish a trade game plan around. My stop loss was close enough nearby, and went back in with size because, my support level and stop level were nearby, and was able to then benefit from the ride up from, 11,000 up to the 60s. And same kind of deal of, in and out and always keeping some kind of core swing position. But with most of my capital at that point, getting really comfortable with just lock it in, just consistently keep locking it in. Because once you see these 90% plus pullbacks 3, 4, 5 times, it makes it a lot easier to lock in gains in euphoria.
At any time during the crypto bull run, did you see evidence that was persuasive to you that, hey, this looks like it's really in a bubble market and I really need to scale back getting involved in that? Or did you not see signs of a significant bubble?
Yeah, and that's where social media comes into play. You're definitely in a bit of a bubble on social media where, in the real world as well, I've got friends that have nothing to do with markets and they're messaging me. That's always a good signal. If they're messaging me about Bitcoin and they never have before, okay, I know that if I put that little piece of the puzzle, in addition to huge volume, in addition to huge run up, those are all the little pieces of the puzzle coming together to create the picture that a temporary top, if not a longer term top, is likely coming sooner rather than later. And so, I say technical analysis, but there are a lot of factors outside of the charts. And that's where social media has changed the game. And social media has gotten useful for, again, just little pieces of the puzzle. I can't look at Twitter and say we're about to top, but I can combine it with other information and it can be useful.
So traders often hear one sector or another frequently being labeled as a bubble, like AI, for example. Is there anything in the charts themselves that one can see that say, oh yeah, this is clearly a bubble? What do you think of AI as a bubble? Or are there currently any bubbles that you're seeing?
Yeah, for me, the chart, number one, I need blue sky breakout, all-time highs. I need a significant amount of gains in a short period of time, and I need euphoria where everybody is, counting the chickens before they hatch, so to speak, and just everybody's all celebrating together. And that's a really fun spot to be in markets, but it is also a clue that it's time to take some profit. And so, one of my better calls this year was in May. People started talking about AI being a bubble. And I'm looking at these charts and saying, I've seen a lot of bubbles and these charts don't have any sign of a bubble for me. You can look now at maybe NVDA and the other large one, the ticker is slipping my head, SMCI, one of those. They are, the extreme all-time high runs that would have me cautious. But then you've got the other names like the stock AI, ticker symbol AI, and PLTR, because they were coming out of a bear market, 2022, they had been just absolutely trashed over the last year plus before this little run got going. And so I'm looking at them in early May and saying, I don't see an AI bubble. These names are only just coming off the bottom, and there is definitely the potential for more. And so at this point in time, I don't really, 2021 broader market definitely had bubble characteristics of, again, euphoria, straight up off the lows, blue sky breakout, all-time highs. And at the point in time where we stand right now, I don't really see many bubbles out there. And that's because 2022 did a good job of bringing a lot of things back to reality. But AI is definitely one that I'm keeping my eye on. And I know that NVDA and that other one are going to top eventually and have, 30% plus pullbacks fairly easily on the longer term timeframes, but just not ready quite yet.
I'd like to transition to relationships and correlations. In many of your videos, you often refer to the dollar index and its relationship to gold. You said a few times that you have to see dollar weakness to gain confidence as a crypto bull. Why do you think crypto is heavily influenced by the dollar? It would seem to imply that crypto is viewed as a safe haven asset like gold is.
Yeah, honestly, I don't have a good answer. I can speculate. And one of the things that I have developed as a trader is the question of why is down at the bottom of the list for me as to, why is this going up? Why? Because I feel like a lot of people that are fundamentally focused, that question why gets them in a lot of trouble where, why is the S&P 500 rallying the last 6-8 months, whatever it is, while, this metric is so weak and this metric is so weak. And so I like to view things as, the why doesn't matter. It's the price is king. Whatever the price is doing, that is reality. And I know that's contradictory to a lot of the old school style of trying to find value, but that's a bit more of a meta conversation is, what does value actually mean? But one thing to, a lot of people look at correlations and give up on them because they are always changing and you got to stay on top of it because they are so rapidly changing. But there are periods of time where correlations can give you really good clues. And so, back a few years ago, I wasn't paying attention to the dollar at all regarding Bitcoin and crypto. But now, I look at every single period in 2023 where the dollar has seen a significant bounce on the weekly time frame. They align with the periods of significant weekly consolidation in Bitcoin. And so, why could that be? I think a lot of it has to do, I noticed that the correlations really synced up, the inverse correlation between the dollar and Bitcoin when we had the regional banking scare. I guess that was back in March, maybe. And that was because of the safe haven mindset where, okay, if these regional banks are having a lot of trouble and your deposits aren't safe and, where are you going to put your money? Well, Bitcoin is potentially a life raft in that kind of situation. And so we saw a bit of an inverse relationship between the regional banks and Bitcoin. There were a couple of headlines that came out where, the headline would lead to the regional banks dumping and Bitcoin would shoot up and say, okay, now after that happens 2-3 times, clearly there's now a pattern. And so it was almost like the dollar just joined in on that. But I fully expect that the inverse relationship between the dollar and Bitcoin that is currently very strong will eventually fade a good bit and become a lot less relevant. And so you just have to, remind yourself not to attach to the correlation because it will change. It will strengthen, it will weaken, and it will completely disappear at times.
I see. So for correlations, do you look at when there's a break in a correlation, sort of like looking at a break in a stock that once it falls below certain key indicators, what have you, and doesn't seem to be rebounding back to the correlation, that you give up on that? You say, well, okay, it's time to go find another correlation. Because they seem to change. I mean, depending on the time frame. Like, for example, the correlation between Bitcoin and the NASDAQ, for example, for a while, they say, oh, Bitcoin is an uncorrelated asset to the market. And then in much of 2022, it said, oh, it doesn't represent a diversification because now it's highly correlated with the NASDAQ, like a 90% correlation. But it seems to, when I look at it, vary significantly between the time frame that's chosen. So, for example, the first 3 months of this year, it showed a decoupling for Bitcoin as it greatly outperformed to the upside. But then the following 3 months showed a significant declines for Bitcoin while the NASDAQ continued to climb. When you look at various correlations between stocks within the same sector or, Bitcoin to the dollar, the gold, what have you, what timeframes do you look at to determine the relative under or overvaluation to each other? And when do you just kind of pull the plug on that correlation?
Yeah, that's a good question. I would say there are even times where I was watching the 5 minute time frame with the inverse relationship between the dollar and Bitcoin, and it was tick for tick. It didn't last very long in terms of it didn't last weeks, but when I recognize that there is a correlation to pay attention to, I just use it again a little piece of the puzzle. I'm not making trade decisions solely based on that information. I'm using it as a piece of the puzzle in my analysis. I'll use other things as well, support and resistance. And I will focus on it while it's there. And then once, I don't really have a set period of time as to how far it has to disappear before I give up on it. But as traders, we have a certain amount of mental bandwidth, and there's opportunity cost of that mental bandwidth. And so, once it no longer serves me, I will ditch it and keep an eye out for other things and, check back in on it every now and again, but not watch it as closely as I was previously. And you're right, the Bitcoin correlation with the NASDAQ has been constantly shifting. And one thing that I've found really well with short-term correlations, whether it's, if I'm watching the NASDAQ and Tesla for day trades, the number one reason a correlation will shift and, completely disappear or things like that will be the individual name hitting a very key support or resistance level. So quick example, let's say Tesla and the NASDAQ are dropping on the 5 minute time frame, tick for tick, doing the same thing, little 5 minute bear flag, new lows. And then Tesla heads down to, the low of last week. And the bulls play a little bit of defense at that price support level. Then you'll see the correlation start to fade a little bit where, okay, wait a second, Tesla's not hitting a new low of the day. And on the last 3 2-minute candles, QQQ has hit a new low of the day, all 3 of those candles. And so that tells me, all right, there's a little bit of relative strength now starting to form. And I will use that in my day trading where I'll then say, okay, well, Tesla is positioned well if the NASDAQ were to put in a temporary bottom here. And so that will often be an indicator where I will then jump into Tesla, place my stop a bit under the low of the day at that point and say, well, QQQ is, the 5 minute RSI at this point is down in the teens and we're due for a short-term bounce. And the fact that Tesla is now trading sideways, it's almost like it's waiting for the NASDAQ to get that little oversold bounce going. And that has definitely become a larger part of my short-term trading strategy as a day trader.
I see. And so will you increase your position size to reflect your increased bullishness on these short-term correlations that say maybe temporarily way out of whack, and you see kind of like a more mean reversion to more normal levels? Will that influence your position sizing, or do you do a fairly standard position sizing for each trade?
It can. I'm fairly standard with my position sizes. There are times where, as I mentioned, scale in, scale out. So if I'm scaling in 2 positions, maybe if I'm less confident in a setup, I'll only do 1. And then if I'm more confident in a setup, maybe I'll just enter both at the same time if my stop level is close by. A lot has to do with calculating risk in terms of, the way I approach risk is I have a dollar amount, which is what I call a day maker level, like my goal of what I want to make consistently. And I'll have a level where if I lose this much on the day, I'm done. I cut the cord because the last thing I want to do is, go on tilt and lose track of myself. And so, if my stop level is close by, I can put on a larger position size and, keep my dollar risk the same than if the stop was further away. And, maybe I have to shrink my position size a bit to have that same dollar risk.
So when you look at stocks and their correlations, say within a particular sector, will you overweight a long swing position, say in a financially weak small caps when a bull run starts because of past outperformance over the larger, more financially stable companies? And one sector that comes to mind right now as we're recording this is the marijuana sector, where I noticed that the very liquid company called Tilray is up less than many of the other marijuana stocks. So currently Tilray is up 4%, and many of the other marijuana stocks are up, double-digit percentage. Would you look at this type of correlation? Would you say, Tilray is up less than the other stocks, the other more speculative, lower liquidity stocks, so it's a good time to go long Tilray? Or would this be a red flag for you? Say, well, if the Tilray, as a more bigger leader, is not up that much relative to the broader sector, that's a red flag. How would you look at this?
That means I should have held on to my Tilray short from this morning a little bit longer if it's only up 4% at this point. But I would take it as a bit of a red flag. And it's definitely liquidity is the issue here, where Tilray is traded on the higher exchanges. I think it's the NYSE. And, a lot of these other stocks are still trading on the OTC. And so when momentum gets going, there's within a sector, there are lower cap names that have higher risk, higher reward. They're going to dump harder in weakness and they're going to run harder in strength. So it's almost like allocating, okay, if I'm playing a sector move, I want to have X amount of capital in the very liquid names where I'm nice and comfy. And then, a certain amount of the capital I want to have higher risk and higher reward with. And I will put that into the less liquid names, knowing that their percentage moves can definitely be magnified. But again, it is in both directions. And so, if Tilray is showing us signs that we're topping out here, then we're going to anticipate that some of these less liquid names can easily, drop significant percentage as well. So if TLRY is topping out today, I'm going to be looking for the other names to potentially top out tomorrow.
You've said in your videos that, what is a bull thinking with this chart and what is a bear thinking? How often do you engage in these type of thought exercises? And does this exercise help you more easily switch from a long to short and vice versa as conditions change, because you're conditioning your brain to be flexible?
Absolutely. Yeah, I do that all the time. It helps from getting tunnel vision and missing something. And, if you've got a bias and you're only looking in this one direction, I found it, very easy to miss easy signs where, if I didn't have the position on and didn't have the bias, I would have seen that very easily. And so I am always, if I'm in a long position or I'm looking long for a trade setup, what would I be looking at if I'm a bear? And oftentimes it'll be a prolonged downtrend of lower highs and lower lows. And I'll look at a chart and say, do I want to look long here? And well, if I'm a bear, I have absolutely no reason to cover right now. And we would have to, take out this level for me to even consider taking some profit on a bearish swing trade. So yes, it's absolutely puts me in a frame of reference and a mindset that allows to diminish that bias regardless of the position that I'm holding.
I notice you frequently mention short covering potential once overhead resistance is broken as giving additional fuel to the upside. To what degree, if any, do you factor in short interest levels? And do you favor going long stocks that have a high short interest once resistance is broken?
I definitely pay attention a lot more after the GME situation. That was an eye-opener, like, okay. And that was almost, we reached a period where the market was just headhunting shorts, where it didn't matter, the fundamentals didn't matter at all. All that mattered was, it doesn't matter the sector or anything like that. If there's high short interest, the Wall Street bets crowd is going to go after this name. And so I do pay attention to it in the sense that, I look at a chart, and if one direction has had control for a very prolonged period of time, and there's a lot, let's just say it's a bear control, and there's a lot of short interest, I know that, all right, I know how markets work, and these bears are getting very lazy, or or complacent is the word I use. They're very complacent because it's been very easy for them to make money for such a long period of time. And we know how quickly the scales can tilt between supply and demand of stock. And if there is a high short interest, I know that it will be almost like competition of buying at the ask. The bulls will be buying at the ask, and the bears will have to do it as well if they're going to cover and not get blown up. So I definitely pay attention. I won't base an entire trade strategy around it. Again, back to the pieces of the puzzle. There's just a handful of things that I'll be looking at, different indicators, different social sentiment, and they all are just little factors into what sets up whether I want to enter a trade or not.
I'd like to transition to psychology. You've said that reflecting upon the conversations going on in your head. Could you expand on that a little bit?
Yeah, that goes back to high school and college psychology courses of just, learning about the id and the ego and all these different things. And it's really, I call it zooming out, where I want to zoom out and observe what's going on in my brain. Because, as full-time traders, a lot of people think, well, you just don't feel FOMO anymore, or don't feel fear. And it's not that I completely erase these emotions from, my body and brain. It's that I'm able to recognize, I'm able to say, I just had this thought, and this thought tells me that I'm feeling FOMO. And so I'm not going to act on this trade because I know that acting on FOMO is not a good thing. And so it's almost like keeping yourself in check, where you're constantly observing. And I highly suggest, and this is one of the aspects where becoming a better trader, if you're really in this, it makes you a better person, in my opinion, where, I can't remember the last time I got mad. I can't remember the last time I lost my temper. And that's because any situation where that would potentially happen, I do that zoom out and I reflect and say, all right, I just, felt my face get hot, and that's happening because this happened and triggered it. And it's almost like it forces you to pause. Some people like to count to 10 or whatever to ensure that they're not emotionally reacting or lashing out in anger, and to take the time to reflect on why you're feeling a certain way. You're doing that. And you have to constantly be observing the thought process that's going on in your head to understand why we as humans are doing the things that we're doing. And as we know, trading is so much about psychology. Learning technical analysis, anybody can do it if you put in enough time to just study and learn the concepts. But really what makes or breaks people is their ability to tackle the psychological aspect of things.
You've also mentioned that balance is important for traders. How did this realization develop for you?
Yeah, and I've refined that a little bit, and in the sense that, I always say balance is key, and you got to get out in nature and get off the screen and not become, completely overwhelmed with it. And that's absolutely the case. But then I reflect back and think about myself and my journey, and every full-time trader that I know. I've got a handful of friends that are full-time traders as well. We all had a period of obsession. You have to have that period of obsession for, a significant period of time if you're going to be able to put in the thousands of hours that are required if you're going to do this for real and seriously. And so, it's almost like, yeah, you got to stay balanced, but I understand that there is a period of completely out of balance. I personally, the amount of time that I put in 10 to 12 hours every day on the computer for years. I mean, we reached the point in 2017, Bitcoin, crypto, where I was completely shaping my sleep schedule, where I would wake up every 3 hours. I'd set my alarm and I'd wake up and I'd see if the trade opportunity had presented itself. And it got to the point where it was, I hope Bitcoin tops, because this is not sustainable. And, I'm going to capitalize on this opportunity while it's here, because I know it won't last, but this is very unsustainable. And so, I would say that when you're learning, you've got to have the period of obsession, but then you get to a point where that obsession is unsustainable, and you've got to set limits to ensure that you can do this over decades, because the last thing we want to do is burn out after, 8 years. And, we're in this game for ideally many decades.
Did you ever find yourself wishing that Bitcoin only traded when stocks did, and didn't trade 24 hours a day, 7 days a week?
Absolutely. In 2017, that was, I hope we top, and it would be really nice if we could have breaks. That was, it's a double-edged sword for sure, because I was, that 7-month period from May to December was just insane in terms of the amount of time and effort. And, it's one of my best accomplishments as a trader was outperforming by trading the significant volatility. I was able to look back and say, well, I performed a decent bit better than if I had just bought and hold and sold the exact top. And so that told me it was worth it to be putting in all this time and effort, but again, unsustainable.
You've also mentioned about visualizing your trading and your personal life. Do you find that the act of visualization helps you to get to your goals?
Yeah, I think there's a lot that science does not understand. And there's two ways to look at this. You can look at it the woo-woo, spiritual way, or you can look at it as a logical way. And for me, visualization is key. It's had a major impact in a lot of my life. After my roommate said, I'm going all in Ethereum, I sat in a hot tub and I really thought out and said, what's this going to look like? And all right, I'm going to put in this much money and I'm going to get a down payment of the house, and it's going to hit blue sky breakout, and just, laying out what I want to see happen. And the woo-woo way is, we create our reality with our mindsets, and, you can go down that whole rabbit hole. The logical way is, if I have a goal that I want to work towards and a way that I want something to play out, a simple example would be, let's say I'm having a cookout next week and I'm inviting a bunch of friends over the house. There's a certain way that I want it to play out. I want to make sure I have enough food. I want to make sure there's activities. And so I visualize what I want it to look like in my brain in advance. And then I just lay out a checklist. All right, I need to do this, 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 and this. And then I just complete that checklist. And then, the thing that I visualized in my head is very close to what the reality ends up being. And I think it's a bit of both. I think there is a lot with our consciousness that science does not understand at this point. And so I don't think it hurts, visualize the reality that you want to create, put yourself in a calming spot where you're able to completely focus on it. And it certainly can't hurt.
Yeah, I've heard the law of attraction fits into this philosophy as well. What do you struggle with most as a trader?
At this point in time, I have it so ingrained in my DNA to wake up and check the markets first thing and check Twitter and, the routine that I've been doing for every single day for, at this point, many years. It's ingrained in my DNA. And, if you ask me, I have a very fortunate life. I'm in shape physically. What's the most unhealthy thing in my life? It's trading. It's the amount of screen time that I'm putting in. And so it goes back to the balance, and I haven't done a great job of that balance. But that is, I would say, what I struggle with most is finding the off switch to be able to completely detach from not just, trading, which I'm able to do, but the social media aspect of things, and just completely unplug and go out camping for 3 days and be able to completely leave this aspect of my life behind. That's something that I've definitely been working on over the past couple of years.
How has the last few years in trading been for you?
It's definitely a shift where, euphoria crypto 2017, and then euphoria everything 2021. And so, I had a real good year 2021, exceeding all my goals multiple times, and was, again, if I'm looking at my returns from a technical analysis perspective, it's, this might be a blow off top kind of bubble, and I don't want that to happen. So essentially, I always talk about pumping the gas and pumping the brakes. And so I intentionally started to pump the brakes. And then once it became clear that we were entering a bear market, my mindset was, okay, I've never experienced this before. And I know from my 3D printing days that I have to experience something and watch it play out if I'm going to be able to capitalize on it. So I didn't try and kid myself and say, all right, I'm going, aggressive in this mindset, whether long or short, because I knew it was new to me. And so that was almost like putting myself in a bit of a timeout and saying, nope, you're going to observe this bear market. You're still going to trade it, just smaller position sizes and less frequent trading. But this one's for observing. And so I now know that the next bear market that we see, I'm going to capitalize on. And there were things about this 2022 bear market where, I watched going back to correlations, I watched our weaker sectors drop first, and then the strongest sectors, I watched them roll over as bear laggards. And, I've seen bear markets in crypto and bear markets in 3D printing, but I've never seen a whole market bear market that acted that way, with the sectors following each other to significant downside. And so I look forward to whenever the next significant bear market is. I have a lot more confidence in my ability to capitalize on that. But the last couple of years, it's definitely slow down mode for me. And again, the number one, I reached a point in my trading career where I was very fortunate to exceed a lot of the goals that I had financially. And again, that's a lot in part due to crypto. And then that went right into Canadian cannabis hype. And for me, my priorities shifted where it's no longer, there was a period where it was make as much as I can. And now the number one priority is do not lose what I've made. I view it as I've won the trading game and I don't want to give any of that back. And so I'll keep adding icing on the cake as I'm able and, keep going for those base hits. But I have definitely shifted significantly from extremely aggressive 2017, aggressive 2018 cannabis, aggressive 2021. And the last 2 years, a lot more conservative mindset, exploring I bonds and T-bills and all these concepts that I would have had zero interest in when my number one priority was make as much as possible.
You shared early on about your lowest point of a trader back when you gave up all that profit in that mining company from 7,000 to 40,000, I think you said, and then back you kind of lost it all. What about your highest point as a trader?
Oh man, there were a few of those from the crypto. Let's see. There was a day in crypto. I hit a profit amount that was my annual goal in a day. My prior annual goal of, if I do this for a living, I had a moment in, I guess, maybe 2013 where I can do this for a living. I want to make X amount of dollars. If I make this amount a year, I've got the life that I want to live. And I hit that in a day with Bitcoin. And then there was another one where I hit, 20% of that in literally a 2-minute bounce trade. And it was just like, this isn't even real at this point. It almost was like dissociating from reality. And then there was another point where, I took my crypto profits before the top and I rolled a significant amount. I looked at the setup and said, there's no way that crypto tops right into a Canadian cannabis run because Canada was legalizing. And I took a massive amount of my profits and put it into those names. And that's the best trade of my life, just in the sense that I took that profit and then went into the next hype market that followed it shortly thereafter and, doubled those gains again. And it was just, again, all the stars aligning of this setup can't be this perfect, but it ended up being that perfect. And again, just, complete euphoria. But that's where we got to zoom out and recognize I'm feeling euphoria right now. I might be feeling invincible. And this is where it would be really easy to get back a lot of my profit. So making sure that we're keeping tabs on ourselves in all kinds of emotional states.
Yeah. The power of self-observation key there as well. I felt really moved by one of your videos describing your proudest moment as a trader, as you were offered a $10,000 gift from a grateful whale trader that you helped out, but you refused the gift knowing that you can do it yourself.
Yeah, that was a big one. And that was 2013 or 14, one of the bigger cannabis penny stock runs. And, at that point, I think I took maybe 15,000 to 100,000 and was just, that was euphoria for me. Absolutely. And so this individual who I think he made $1 million during that run. We were all hanging out in a chat room. We got to know each other, talking about his kids and all that. And so, yeah, he offered me, 10% of my net worth for helping him out. And it was just that reflection of, I just made a significant amount of money. I'm feeling really good and confident about everything. You've got a bunch of kids. I wouldn't feel right taking that money. And in hindsight, I'm very glad about that because unfortunately, this individual held on to a lot of the penny stocks and gave back a ton of those profits. And so I definitely would have had a bunch of guilt around that had I taken it. But that was a big defining moment for me in terms of my own confidence. That was about the time where, I can remember around that time, I remember walking out of my bedroom. I was visiting my dad at that point, and I said, with full confidence and certainty, I'm going to be a millionaire. Like I just know it. Like I'm going to be a millionaire. And that was, again, visualization and that aspect of things. And that's the kind of confident mindset that I was in that allowed me to pass on that gift.
Fantastic. Yeah. Congratulations. I noticed also from your videos that you're rather big into farming and you have quite a few different animals on your farm. Is that, do you like being a farmer?
I do. And at the moment I've downsized the animals as I bounced around. Really what it was when we, when I started going full time into trading, I was staying in a community home with my entrepreneur friend that I talked about. And I was the farm manager where I was keeping my cost of living really low, rent free by, doing the garden and taking care of the pigs and the goats and the chickens and the ducks. And so every day I would wake up with the sun and milk the goats and take care of everything and then go back to the computer. And it was just the perfect balance where I could literally, walk 200 feet outside of where I was trading and be surrounded by this little farm oasis. And so that really helped with the balance a lot. and perspective, keeping everything in perspective in terms of, what's most important in life, because it's very easy to get caught up in a win or a loss. And, the importance that society puts on monetary value, but just always staying grounded and remembering that there is so much else out there. So yeah, farming always has had a significant impact in my life. And I love it. Really, the past 4 years, that's my life. Is if I'm not trading or out in the garden growing food, that's 90% plus of what I do in my life.
Yeah, well, thanks for coming on Chat with Traders, Dan.
Absolutely. It's been a blast. I appreciate you having me.
Yeah, how can our listeners get in touch with you?
On Twitter, we're at Chart Guys. And of course, chartguys.com, the website. We've got our YouTube channel has, I think we're pushing 10,000 videos at this point. A lot of them are not relevant anymore because they were going over the market, but a ton of them are lessons and concepts. We've got the playlists about psychology and emotional control. So go to Chart Guys on YouTube and go through those playlists. There are dozens of hours of useful information.
Yeah, great. I've certainly gotten benefit from watching your videos. Thanks again.
Thanks for having me.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers open the doors. Mobile